the next couple of months, we will see significantly stronger inflation.
The consumer is still seeing spending in excess of what would be considered a normalized pace of spend.
This summer is going to be huge. People are going to spend, and the bounce back in oil demand is probably going to be significantly more than people have been expecting.
Certainly some commodity prices are just completely out of control. It's almost hyperbolic.
We are now at a point where supply is extremely low, inventories are extremely low, and demand's roaring. So prices are extraordinarily volatile.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
It is CPI Wednesday from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance alongside Tom Keene. I'm Jonathan Ferro. Lisa Abramowicz is out of the building. She'll be back on Monday. Tom, can we call it CPI Wednesday? Is that the new
I guess
branding?
we can, and it's a big deal. It's a bigger deal this time around than maybe in the recent weeks. Is it like Jobs Day Friday last time? Is it like retail sales coming up Friday? Maybe not. But, John, there is a mystery to it around better data on European GDP.
You used the S word a little bit earlier this morning, Tom. Stagflation.
It's
Where's
one of
that
the
come
outcomes.
from? Why?
It comes out of the equity sweat that's out there right now. And you know, John, I've been really upset about Crush. Let's bring it up right now. Crush, Dow, down 1.6%.
Yeah.
Standard & Poor's crushed, I say, down 2%. NASDAQ 100, call it, down 5%. But, John, it's a pullback, and it's like that lingering fear, GDP maybe not there with this rising inflation. You saw Jan Hatzius say maybe not.
I hear you. Upside risk to inflation, downside risk to growth, maybe relative to expectations.
Maybe.
I'm with you. This time yesterday, we were blaming pretty much everything on inflation. Then at the close, what was at the bottom of the pile, Tom? Financials, energy.
Yeah.
Top of the pile.
It was an odd day.
What was that about?
Very odd day. And what I noticed was NASDAQ 100 coming on at the end of the day. I really don't have a good feeling here. Right now, I got NASDAQ 100 down 0.6%. Small caps down a stick right now. That gets my attention. But, John, it's a jumble. Maybe it's Jumble Wednesday.
Jumble Wednesday. Everything you look at speaks to strong demand and a problem on the supply side. Did you see the small business survey that came out yesterday morning? Tom,
it's a
job
boom economy.
openings absolutely surging.
And this is important, folks. John and I go blather, blather, blather. Michael McKee actually works at this. He's got a real job. And McKee really cares, John Ferro, about job openings, and they were a boom.
Are you implying we don't have real jobs?
No, we don't have real jobs, John.
Okay.
We get to come in, and we're wearing ties today. An uproar yesterday when we were tieless with Hatzius. I feel better like this.
Maybe they should come off at 8:35, 5 minutes after the print.
Of Inflation Wednesday.
Yeah, maybe. Futures this morning, down 14 on the S&P 500, 41.32. I'll do my non-job. We're down a third of 1%. In the bond market, yields come in a basis point, 161.12. A little bit of supply later, 40-odd billion of 10-year notes coming to market a little bit later this afternoon. In the FX market, euro weaker, euro dollar 121.33. And just to add fuel to the commodity debate, the inflation debate. WTI 65, 71, up 0.7%. Tom, we've got a gasoline shortage, so let's discuss it just briefly. A lot of people on Wall Street, of course, will wait for this number to come out at 8:30 Eastern. For many other people in this country, their experience of inflation is not a CPI print on a Wednesday morning at 8:30 Eastern time, Tom. Their experience of inflation is what happens every day when they go to the fuel pump, when they go to the grocery store, when they go to buy everyday items, when they pay the rent, when they try and buy a house.
Yeah, they do. I mean, it's out there, and gas is part of it, and there's a lot of rationalization by fancy people in suits and ties that it doesn't matter, but it does matter. John, I have to point out the 10-year real yield continues to break down. This is a huge backstory this week about the inflation-adjusted yields just aren't happening. They're going to new negative numbers.
Mr. Dudley with a new Bloomberg piece this morning, Tom, suggesting yields can go higher.
Nominal yields can go higher.
Underestimating the path of short-term interest rates over the next several years, and for that matter, yields can and should go higher. Yeah, it's an important statement. It's something to theme about here as we go to retail sales on Friday. But on Inflation Wednesday, I mean, what series are you going to look at, John? There's like 14 flavors of inflation. I think most people go to core, strip out food, strip out energy. The estimate at the moment, Tom's 2.3% from a previous 1.6%.
Oh, no.
If you're going year on year on the headline number, that's at 3.6 versus the previous read of 2.6. Yeah. Number one thing we learned yesterday, John, on inflation was pricing power among selected corporations, and a lot of people I heard alluding to the idea of big tech
Microsoft and the rest, they have pricing power.
Let's bring in Harm Bandholz, shall we, of
Let's
Kiel
do that.
University,
Wonderful.
economics professor, formerly of Udi Credit. Great to catch up, Harm, as always. 8:30 Eastern time, that's when we get the CPI print. Harm, how are you interpreting the incoming data? What are you looking for?
Yeah, good morning. First of all, I have no tie either. I apologize, but
Well, you're an
That's
academic
an
now.
academic thing, you
You're
know.
allowed. Carry on.
yeah, it is really, as you both talked about earlier, the market is right now obsessed with inflation. Everybody's talking about higher inflation. And then we have a report coming out today which will show higher inflation because we have a base effect. Last year, exactly a year ago, April 2020, the COVID caused a big drop in the CPI ex food energy. That base effect is now getting out of the system. So this is why we get what John talked earlier about, the big jump in the headline numbers. So I do think actually the market will, because it's looking for higher inflation, will also have a look at the rise in the headline figure to 3.6%, because that year-over-year spike is the biggest in, I think, 10 years. So, I think this will make headlines and it will corroborate the market notion that inflation is spiking and all the inflation dangers are materializing.
Let's pick up on one dilemma right now, Harm, just to jump in and look at the labour market. We had job openings yesterday absolutely surge in America to records. Then you look at small business surveys coming in America. Here's one. A record 44% of respondents said they were unable to fill positions. 31% said they boosted worker compensation. So, Harm, just as a little case study right now, that job openings issue, the problem on the supply side, is it an issue solved by time or by higher prices?
No, it's solved by better education, right? So it doesn't go away by time, and we have been looking at these numbers, and to be honest, I have been using this time series always as a reason that wages will go up and rise stronger, and to be honest, it has not really materialized in the past, and I'm not quite sure that it will materialize in the future. But taking a step back, you mentioned the word stagflation. There may be a little bit of the latter part, i.e. inflation, but I think there's no doubt that there will be no stag. Mm-hmm. So the U.S. economy will grow strongly. If it's 6-7%, we don't know. It also depends a little bit on the quarterly pattern. But the numbers are strong, and the economy will grow at a very strong pace. So, and this is all corroborated. I just don't think it will lead to sustained higher inflation. Right. So I'm more with the Fed, thinking that it will be a temporary.
Ian Harmon, John, just in the last hour, Navarro over at Citigroup reaffirms the resilience of the United Kingdom economy, and Goldman Sachs really in the last 15 minutes readjust 2021 UK GDP ever higher as well. Harm Bandholz, when you were in UniCredit, you gained worldwide fame with an essay on Riyadh, Saudi Arabia, and the price of oil. We've now got gasoline moving up, Brent crude back to 70. Do you see oil as part of the inflation discussion?
Sure. And as I said, the market wants higher inflation right now. It doesn't know if it wants it, but this is what it focuses on. And then, of course, as I said, you have for April these stronger numbers, the base effect. Then coming into May, we have gasoline shortages. And as we all know, that boosts headline inflation, and it trickles also through to some of the core CPI numbers. So usually the core CPI is also positively affected when gasoline prices go up. So so this debate will stay with us also when the May numbers come out.
Part of your job at UniCredit, I know you don't have to do it in the ivory tower of Kiel University, but part of your job was to link this into market performance. For our viewers and listeners, how do you link inflation worries on Inflation Wednesday into what the stock market's going to do? What's your correlation there, if there is one?
Well, the correlation is probably if the stock market thinks that higher inflation leads to higher interest rates, then the stock market doesn't like it. On the other hand, of course, gradually higher prices should be good for the stock market because gradually rising prices also means, as you mentioned earlier, higher pricing power, and that increases the top line. So, but when we see the sell-off, I think we must not take it out of the overall context. Stock markets are, in my personal view, very expensive. And I know, Tom, you like statistical numbers. I'm looking at the S&P to nominal GDP ratio. I always call it the economist's PE ratio. This has been 3 standard deviations above the long-term average. Comparison, during the 2000 bubble, during the dot-com bubble, it was 2 standard deviations. So stock markets are just very expensive relative to the economy. And if we then see a couple of days or so of a sell-off, maybe we must not take it out
John,
of
isn't
context.
it, John, it's just fabulous to have our first guest of the morning talking standard deviation.
I just love that the former economist from UniCredit now does stocks, Tom. That's what I'm enjoying about this. The academic just loosening up a little bit and going into the stock market.
Can you imagine
tell us what
being
he
in
thinks.
his classroom? Do you realize all of his students own Bitcoin?
I'm sure they do. We've got to leave it there.
No, I hope they don't. I mean, I'm just careful, but that has not changed.
You've got to comment on Bitcoin too. We've got to leave it there. Got to run. Harm Van Holtz there at Keele University.
Don't be a stranger.
Thank you very much. In the last couple of weeks, a big story has been developing, politically speaking. Arkansas, North Dakota, South Carolina, Montana, Iowa, now Missouri, Tennessee, joining, Tom, a club of Republican governors to suspend, get rid of the additional $300 of unemployment benefits that you receive in the United States of America. I say it's a political decision. It will have economic consequences.
John, I said this before, and I'll review it once more. The University of Chicago has done brilliant work on this. The New York Times did a huge layout on it a year ago or so. And the answer is you're absolutely right. There are selected states where clearly that unemployment aid really stops job formation. But there are just as many other states where that's not true. How do you partition them? Clearly, it's been a failure of politics.
St. Louis Fed President Jim Bullard actually raised that in a CNBC
What did he say?
interview yesterday. I
That.
thought it was quite interesting, actually, Tom. He raised the fact that maybe using one blunt tool of fiscal policy without looking at the respective rural areas and each and every economy in each state has a different experience. 3.7%. Governor Reynolds pointed to a 3.7% unemployment rate, Tom.
Yeah,
3.7, it's exceptionally low out there.
And to the viewers and listeners in urban areas where there's higher unemployment, I mean, we talked to Stiglitz the other day about his Gary, Indiana. They're not at 3.7%, and they need that unemployment aid.
So what happens in the next couple of months in these states? Do you start to see those job openings get filled more quickly? Or does it have adverse effects because of childcare issues,
I want to be more
etc.?
optimistic. You're going to have growth come in. Growth's going to slap in. And then the growth debate Q3, Q4. Imagine Inflation Wednesday, John, in November.
CPI Wednesday, Inflation Wednesday. How are we going to brand this?
I don't know. What are we going to do with Thursday?
I don't know.
Tots Thursday. I love
Thursday.
It works.
That's very you. Very
Thank
you. The Big Four meeting the President of the United States down in Washington, D.C. a little bit later today. We'll catch up with the team down in Washington in just a moment. Equity futures 41.39 on the S&P. From New York City, this is Bloomberg.
With the First Word News, I'm Ritika Gupta. Colonial Pipeline says it will know by late today whether it's safe to restart gasoline and diesel flows. They've been on hold since hackers targeted that giant pipeline last week. Fuel shortages have spread quickly across the southern and the eastern U.S. Energy Secretary Jennifer Granholm says even if Colonial can restart today, it will take days to ramp up operations. Israel stepped up its attacks on the Hamas-ruled Gaza Strip overnight. Rocket squads in Gaza fired a barrage at central Israel early today, while Israeli warplanes pounded Gaza with dozens of airstrikes. At least 35 people have been killed in Gaza, 5 died in Israel. It appears to be the most serious escalation since a 2014 war in Gaza. And Donald Trump's former acting defense secretary says there was a reason he was concerned about sending troops to protect the Capitol before the January 6th riot. Christopher Miller will tell a House committee today he thought the deployment would heighten speculation about a military coup. He'll testify that he didn't think the military should have played a major role in enforcing the law that day. It's another tax defeat for European Union competition chief Margaret Vestager. Amazon has won a court fight over the EU's $303 million tax bill. The EU General Court ruled today that Amazon did not get special treatment from Luxembourg's tax authority. Last year, Apple successfully challenged a record $15.8 billion EU tax order. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
The Fed's view is if we tighten and the stock market goes down at some subsequent period of time, that will tighten financial conditions, and we may then not have to tighten monetary policy quite as much. But they agree that markets are frothy, but they're looking through that. They're determined to keep rates low until they actually get a lot more people back to work.
That was Bill Dudley of Bloomberg Opinion from New York City this morning. Good morning. Alongside Tom Keene, I'm Jonathan Ferro. Lisa will be back with us next week. Here's the price action this Wednesday morning. Going into a CPI print just a couple of hours away. Equity futures down 10 on the S&P. We decline a quarter of 1%. I was expecting that. In the bond market, yields come in almost a basis point. The 10-year in focus a little bit later on. $41 billion of 10-year notes coming to market.
Is that a lot?
In the Treasury. It's a fair bit, isn't it, Tom? A little bit more supply later. In the FX market, euro dollar 121.34. We decline 0.1%. And crude, just to stay on top of the commodity story, up 0.8% on WTI, just south of 66 at 65.82.
In the good news of Europe, I want to note my benchmark, the 20-year Swiss full faith and credit to a positive 0.091. That's a huge deal and a huge vote on European growth over the last number of days. Right now in Washington, John wants to talk about the things that are serious right now, but there is a parlor game known as the future of the Republican Party. Emily Wilkins joins us now, Bloomberg soap opera reporter. Emily, Ms. Cheney, I guess, is out today from Wyoming. This has been widely reported, but we've got the Republican Party where we've got 100 Republicans, I love this phrase, planning to threaten. What in God's name is plan to threaten? What can the Republican establishment, a la Congresswoman Cheney, actually do against the group of Trump?
I mean, that's kind of the big question right now, because if you look at where Republican voters are, and voters are the ones at the end of the day who ultimately have the power, the voters are still with Trump. We saw a Reuters poll last month showing that 81% of Republican voters still approve of Trump, 55% believe that the 2020 election was stolen and should have been won by former President Trump. And so you still have the voters going with Trump, and lawmakers like House Minority Leader Kevin McCarthy know where those voters are, and he knows what he needs to do to win in 2022.
What is the power of the traditional Republican establishment? I don't detect any.
I mean, things have shifted dramatically within the Republican Party after the rise of Trump to the party. And yes, you still have individuals like Liz Cheney, you still have individuals like Adam Kinzinger, you still have groups out there that are backing and supporting those sort of Main Street Republicans and conservative values. But for the most part, at the national level, the calculation has been made that if Republicans want to win, they need to keep Trump on board.
And John, I know, John, you want to get to inflation and the talk that's out there, but, you see little internecine warfare where Stephanie Murphy of Florida is going after Marco Rubio's seat. I mean, all of these are little battles, John, to begin 2022.
The battle in front of us today, though, is a meeting with the Big Four in the White House. Emily, can you sort of describe what to expect from that a little bit later?
Yeah, we're going to be seeing the four top leaders in Congress. That is Senator Mitch McConnell, Senator Chuck Schumer, and the House Speaker Nancy Pelosi, and the Republican leader in the House, Kevin McCarthy, go ahead and sit down with President Biden. This is actually going to be the first time that McCarthy and Biden actually sit down together and chat since Biden became president. And it's sort of seen as this big move for potential bipartisanship. The question, of course, can something get done on that infrastructure package that President Biden is pushing? He'll need leadership to get buy-in for this if he wants to pass a bill in a bipartisan manner through Congress. So this is going to be a clue. Is Congress going to wind up trying to take a bipartisan track with the infrastructure component of this bill? Or are Democrats just going to say after this meeting, you know what, we tried, it doesn't look like we're going to have Republicans coming along with us, and we need to start moving through reconciliation, which will substantially change what can or cannot be in an infrastructure package.
Before we turn to a critical foreign policy issue that's been brewing and really flared up in the last 24 hours, just finally on the domestic issue, I count 7 Republican governors now. Arkansas, North Dakota, South Carolina, Montana, Iowa, Missouri, Tennessee, stepping up in the past week to effectively end or declare the end at some point in the next month, the additional $300 of unemployment insurance. Emily, I keep asking the administration, have you spoken to these governors, whether it's Secretary Walsh, whether it was Jared Bernstein yesterday? They would say no, but someone internally has. Has the president? It's not clear. Has the president spoken to these governors about the decisions they're making?
We don't have any indication at this point that President Biden has spoken with these governors, but we are starting to see more movement on this in Congress. You saw yesterday Senator Roger Marshall of Kansas introduce a bill to end these benefits, and you saw 10 of his colleagues sign on to that legislation with him. The issue is that what you hear from President Biden and what you hear from Democrats is that they don't believe that the weak jobs numbers that we saw last month are a result of these unemployment benefits being so high. They say that what that actually is because it's a lack of childcare for families who, they can't return to the workforce because their kids still aren't back in school, as well as general concerns about people worried about their health, worried that if they go back, they could still potentially catch coronavirus.
Emily, for all of us, whatever our age, there's an architecture of our history with the Levant. It could be the bombings in Beirut years ago. It could be 1967. Frame where we are at this moment with Palestine and Israel and the headline out moments ago of the president's consideration of another envoy.
I mean, there's always been a lot of partisanship and a lot of tension around the Palestinian-Israeli issue. I mean, you've seen lawmakers repeatedly weigh in on it over the years. It's very divided between Republicans and Democrats. I think at this point we've continued to see that pattern develop in Congress, sort of as far as where the lines fall and who is pushing for what. And so I think at this point we're going to continue to see more of the same, even as violence in the area continues to ramp up.
Emily, it's good to catch up. Emily Wilkins there down in Washington, D.C. of Bloomberg Government. Tom, the Israeli military saying 1,000 rockets have been fired from the Palestinian enclave. And I think this has been described quite widely as some of the bloodiest battles we've seen, at least since 2014.
Well, the markers to go back 7 years, as you say, John, but really the markers to go back forever. And with the administration change, to me, the greatest mystery, and I'm looking at this as an amateur from a distance, but John, the greatest mystery for me is the relationship of the President of the United States with the Israeli government, with the turmoil there of the domestic election. I'm curious how that relationship frames out after what we saw with Trump and Netanyahu.
Would you be comfortable characterizing this as the first big foreign policy test of this administration?
In terms of smoke, bombs, pain, agony, and death, absolutely, John. But his card is full. His dance card is full worldwide.
You alluded to that headline that crossed a couple of minutes ago. It comes from Axios. President Biden weighing sending an envoy to Israel for de-escalation efforts. And de-escalation, the call's coming from all sides at the moment, Tom.
It's coming from all sides. The United Kingdom will weigh in. We've all seen the ballet before, but the number one ballet is to stop the carnage. And as you say, it's not a question of one shot here, one shot there. It seems like overnight there were many different fronts to this new war.
Yep, and as the headlines cross, we'll keep you on top of the news flow here at Bloomberg. From New York City, alongside Tom Keene, I'm Jonathan Ferro. It's the price action as we count you down to a CPI report in the United States of America. Equity futures 41.37 on the S&P 500, declining 0.2%. Let's call it 0.25% lower. In the bond market, yields come in a full basis point now, 161.12 on a US 10-year. From New York, this is Bloomberg Surveillance. Messy couple of days in this market. Some price action, looking for a narrative. You know how it works. Equity futures down about 10 on the S&P 500. We decline about 0.25%, 2 hours away from a CPI report in America. It is CPI Wednesday. Nasdaq 100 futures coming in about 0.5%. You're underperformance on the Russell right now, Tom. We're down 1 full percentage point. Let's get to the bond market. An upgrade from BMO on the S&P 500 from 42 to 4,500.
Yeah, Brian Belsky doing that.
Brian. Upgrading energy too, Tom. We'll talk about energy a little bit later. 10-year yields right now, 161.12. Coming in about a basis point, about 233 on 30s, and about a basis point there as well. Some stability over the last couple of days after we gapped aggressively lower in Friday's session. Here's the story, though. The big debate right now in the United States and worldwide. We don't have a demand problem. We have a supply problem. And capturing that perfectly yesterday was this. Switch up the board. Job openings in America. 8.12 million from 7.5 in a previous month.
Nice chart. On
Tom,
radio, that's the most important chart, job openings.
A record.
Yep.
It's a record. And the big debate right now is what will solve that gap between demand and supply. That chart's
John,
phenomenal.
I did some research yesterday on this. I was at McDonald's, and they made very clear to me they could serve more people. They're packed, and they're just starving for labor.
Yep, and I don't think they're alone, and I don't believe you were in McDonald's either. Were you really in McDonald's? Were you really? I'm not going to go with that. I don't believe you were there. I've seen you there once.
It's around the corner from Hermes.
I don't care
it's
how
the
close it
McDonald's
is to
around the
Hermes.
corner from Hermes.
What
Leave
did
me
you
alone.
get? What did you get?
I got nothing.
You just walked in to do a labour
I
market
had the
survey.
lobster risotto, okay? Good morning, Amaranth. Great restaurant.
Carry
Great
on.
artwork.
Carry on.
Are you done?
I'm done.
Thank you,
I'm
John
so
Ferro
done.
with the data there. And on Inflation Wednesday, seriously, folks, we're seeing incredible nuance in the yield market. Right now, you don't know what to do in the equity market. I don't know what to do. John doesn't know what to do. Eric Friedman has a very nuanced view with U.S. Bank Asset Management and their chief investment officer. Eric, good morning. I love your research note. I want to start with just a simple call, as John just framed, with BMO and Brian Belsky catching up with you. You're at 4,600, up 11%. I want to focus on just up 11% from here. Are you lonely, or do you think a lot of people have that view?
Good morning, Tom. We are a little lonely here, and I think that the next couple quarters really test that 4,600 number for us. I think the one thing that's really positive is the momentum that came out of this past quarter's earnings. Lots of upside surprises on both revenue as well as earnings. So we think there is some scope for some upside revisions, but that transition from Q2 to Q3 will be really important to gauge.
I mean, what's so important here, folks, is it's so cold at Colgate University in the winter that everybody studies statistics to stay warm. Eric, I love in your note you talk about in-sample volatility. That's a fancy phrase for the internal dynamics of the market right now. What does in-sample volatility tell you about being a bull?
The biggest thing, Tom, is the composition of the market is changing, and it is at the margin right now. But to your point earlier from an earlier segment, the composition, if you will, in terms of the reopening trade versus more of the, let's call it steady state winners of technology and healthcare, those are things we're really gauging. So if you look, for example, at the UK, which Jonathan, of course, knows better than I do, that the compelling reopening is occurring, and the question is, will investors continually pay for what feels like a fairly well-known story, which is reopening is going to happen on a more gradual basis. So we do think that this shift back and forth across sectors is normal, although for the last couple of months it's been maybe a little abnormal. So we think this is probably a dip that's worth buying, but we should probably see a little more volatility before getting more excited.
We've caught up with a lot of people, Eric, that have talked to us about staples, pricing power, go to staples, BTIG, Morgan Stanley, others as well in the mix too. Do you share that view?
We do. We think, Jonathan, in fact, a really good conversation you had yesterday was on technology, their ability to maintain that pricing power. We think that there may be some substitution effects at the lower end of staples. But if you look at technology, what CFOs will spend on repeatedly, unlikely to have a lot of substitution. So we think that inelasticity will persist. And so that really leads us to think that technology is worth looking at here, given some of that ongoing pricing power in tech, as well as some select staples names as well.
What's really surprised me over the last several weeks are the obsessive talking points around inflation. And TK, I'm sure you've got a view on this as well. We've almost disregarded what happened with margins through Q1. Margins were fantastic, despite the fact there was price pressure, because some of these companies, John, Eric, got to pass on the costs.
Eric, jump in here. But, John, my number one point is corporations adjust. That's my number one point.
And they did
Adapt.
adjust. Now, Eric, I think the question is whether they can repeat the act in Q2, Q3, Q4, whether there is some margin risk.
I think so, Jonathan. If you look at especially CapEx trends, which we think will pick up, that's something that will start flowing through the income statement. If people are anticipating consumer spending, not just in the U.S., but also this glide path globally. And not that we want to have one more case of COVID, but as we've seen a gradual reopening, whether that's in the continent, whether that's in the UK, ultimately India, Latin America, that could provide a really diet for CapEx that persists, that could also challenge margins. So we do think that margins has some pressure. We'll see if investors keep paying up for it. We think that they will.
Eric, I want to talk about use of cash. I'm beginning to see the articles percolate in of what Lisa, John, and I have talked about, which is, you know what, they're going to buy back shares. Give me your view of the rest of the year and into next year use of this titanic profit that corporations are seeing. They've only got one path, the CapEx, yeah, I get it, but then we're going to see share buybacks as we've never seen before.
We've got a really large capital markets business, Tom, and so talking to that team, that CFOs are really thinking about being more aggressive in terms of M&A and also continuing with share buyback. So that, funding is not an issue. People have no problems raising capital. There's lots of places where they can find it. So that's going to be likely something we see continue. Again, it will likely be an ongoing bid to underlying equities, but don't expect that trend to roll over anytime soon.
John, did you get your 40-year Amazon piece? Did that trade happen?
I didn't. At 95 basis points over, I wasn't enticed.
Did PIMCO push you aside?
That 2-year piece, though, at 10 basis points over Treasuries, wasn't that something? Eric, it's amazing. We've just had an 8-minute conversation almost on the market, and we haven't talked about the Fed. Forgive me. Can we talk about the Fed? Does any of this play into the way you think about the equity market, Eric, going through summer?
No, it does. And Jonathan, to your point from your tweet this morning, that people like Richard Clarida speaking, people like Lael Brainerd, these are stories that we're going to keep following and paying attention to, because at the margin, there seems to be some very modest cracks in the foundation of we're not even thinking about raising rates. So as we see some more conversations develop about that inflationary pressure, which we can't, again, we think it's going to be more transitory, but we can't bypass the fact that the Fed may lose patience and in fact, may change their stripes. So that's something we're very much paying close attention to.
Eric, I want to go right to Fear 101. I mean, this is the reality. There's a lot of people that feel they haven't participated in this bull market. They don't own the big tech, et cetera. Where do you place fresh capital now if you've missed out and you want to get on board, but you're scared stiff?
There's probably two places we prioritize, Tom. Number one would be domestic mid caps. It really sits in that middle point, if you will, between momentum small as well as large cap, which of course has done very well. So that tends to be a very underloved and underfollowed part of the U.S. equity market. We'd be buyers there. For those that want to scale into pieces within the fixed income market, we still think that these are things you can actually own. These aren't esoteric parts of the market. So things like non-agency mortgages, those are spots where we still think you can capture some yield and not take on too much portfolio risk. So those would be two areas we pay close attention to. We also think, again, over time, that the ongoing bid from CFOs for technology will persist. So as that continues to struggle, that's a spot that investors can start picking away at.
Love that. Great to catch up. Eric Friedman there, U.S. Bank Asset Management Chief Investment Officer. On the Fed speak, Rich Clarida, the Vice Chair, a little bit later. Tom, we'll hear from Rosengren, we'll hear from Bostic, and I believe one more, Harker, a little bit later.
What are they going to say about
inflation?
I mean, I guess they wait. It's Inflation
Wednesday. I think that's why these speeches are scheduled for some of them, Tom.
Yeah, they
see what they've got to say, now they respond to it.
Yeah, John, help me with football right now. It's like the end of the season. Most of the leagues is like 3 or 4.
Which league do you want to do?
No, but there's different leagues. I can't keep track of the leagues, John.
Well, neither can I.
Look, it's simple. American League, National League. Okay, simple.
That's baseball.
Football's not, soccer's not like that.
Yeah.
How late are we in the season? Like we're here, right?
We've got 2-3 games left in most leagues across Europe. 2 or 3. Relegation's dealt with in the UK. Right. Now we've got to focus on those top 4 spots. Manchester City have won the league. Who qualifies for the Champions League? Will Liverpool miss out? Big question. Serie A in Italy. Will Ronaldo and Juventus miss out on a place in the Champions League? That's the race right there, and a really tight race in Spain with Atletico Madrid leading the way.
God, you're like Maria Tadeo. It's like
Maria Tadeo is far better at this than me.
Now look, we really are focused on diversity here. And Abramowicz front ran us before she went away on her sabbatical.
What did Lisa say?
Abramowicz went out and hired an Arsenal supporter for our team. Did she clear this through you?
I have not heard about this.
I have not heard about this.
She hired an Arsenal supporter. I thought she was an Arsenal supporter.
Yeah, that's why. What do you think she's doing here?
She's hiring Arsenal. Who's the Arsenal supporter?
We have Maxwell in London, who I'm told is an Arsenal supporter. I mean, this is un-American. Maxwell. It's not supposed to happen.
Very cool.
After the Super League, this should not happen.
Is Maxwell listening today?
I have no idea.
I have no idea because I have no idea what you're talking about. Do you want to talk about the market?
I guess so, but we got an Arsenal supporter. I'm not happy.
Okay, we can move on.
The market,
we can
futures
talk about
-9.
We can talk about CPI. Tom, we could talk about that massive monster job openings figure in America.
Yeah, let's talk about that.
Pick.
On radio, folks, a chart, and it is the chart of the moment. John's 100% correct on that. John, moonshot covers it. Out of the pandemic, it's a true moonshot. And I don't know, email us in, folks. We're living it in New York City.
Do you think this is something we solve with time? Just several months? Or is this an educational issue like Harm Banholtz was talking about? Is this a price issue? a labour market price issue, a UI issue?
It's a natural disaster issue. We're coming out of a natural disaster. But what's fascinating here, John, is what is the power of labor to demand higher wages? And that's a mystery. Anybody who says they got a theory, I'm not interested. We need to observe what wages and benefits do, particularly in, I'd say, the 3 or 4 lowest deciles out there.
I think it's pretty clear that the economics profession nailed the demand picture, really got a decent gauge of demand, and has really struggled to understand whether supply can meet it.
Yeah, it can be that way. And with commodities, look at copper today. I mean, even copper had another lift today.
Transitory. I've heard that once in 40 minutes.
I know, it's
Are you
good.
impressed? Going into an inflation number at 8:30 Eastern Time, you're going to hear that number a whole lot more throughout the afternoon.
Inflation Wednesday.
And that word repeatedly. Transitory. In your equity market, 41.37. On the S&P 500, we declined 0.2%. With Tom Keene, Jonathan Ferro, and a hello to Lisa Abramowicz, who we have no idea where she is. She's going to be back on Monday.
With the First Word News, I'm Ritika Gupta. The White House is facing rising pressure over gasoline shortages caused by the shutdown of that giant pipeline. The EPA has waived requirements across 12 states and Washington, D.C. to help bring more fuel to areas normally supplied by the Colonial Pipeline. North Carolina and Virginia declared states of emergency as gas stations ran dry. More than 100 Republicans reportedly are threatening to leave and form a third party. A statement is expected to aim former President Trump's stranglehold on the GOP. The New York Times says the group is headed by Miles Taylor, a former Trump-era official who wrote a book blasting the administration. Taylor says those who will sign a statement include former governors, lawmakers, and cabinet secretaries. Reuters says former governors Tom Ridge of Pennsylvania and Christine Todd Whitman of New Jersey will sign it. In the UK, Prime Minister Boris Johnson indicates that an investigation into his government's handling of the pandemic will be set up within a year. The government has been criticised for a number of things, including waiting too long to impose lockdowns, but Johnson is now riding high after a vaccine rollout that has already administered doses of more than 50 million people. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
Every country in the world is now looking to us to provide for their lack of capacity to produce and or have vaccines. I'm not going to shortcut the United States of America. I promise you we're going to have enough vaccine for every single American. But we are going to be engaged in working with other countries.
America first, but we will help the rest of the world. The message from the President of the United States. From New York City this morning, good morning. Alongside Tom Keene, I'm Jonathan Ferro. Here's the price action this Wednesday morning, going into an important inflation print a little bit later. 8:30 Eastern Time. It is CPI Wednesday. In your bond market, yields coming in a basis point to 160.94 on 10s. Euro dollar 121.29. We're coming down about 1/10% there. Just a touch of euro weakness. A little bit of commodity strength. The 66 handle.
Yes, a little
on
bit.
WTI.
Well said.
$66 and about 5 cents, Tom. Up by 1 full percentage point. The S&P 500 down around about 1/3%.
I use on commodities as a proxy, folks. Looney. This is dollar Canada, USD CAD 120.88. To see it break down to 119 would be a big deal. We're not there yet. As John mentioned, as the president mentions, it's a global pandemic. The U.S. on the road to recovery, maybe not. Lauren Sauer joins with Johns Hopkins here. And Lauren, we noticed overnight out in San Diego, the wonderful Padres, their superstar Tatis and also Will Myers out with COVID. They have 3 other players in contract tracing. They have 5 of their on-field players out of commission. How do you have an athletic team with 5 people out in the song and dance that we're going to fill the baseball park, in this case, Petco Field?
Yeah, I think that what that shows is that COVID is still among us, and we still have to be very, very careful. We're seeing that even though we're seeing these drops in cases across the country, there are pockets, especially where people are have less vaccination rates, and in those areas, people are still highly susceptible.
Okay, this is really, really important, folks. I'm going to stop the show because John Farrell's been way out front on this. Lauren, if I'm walking down the street, should I have a mask on as a courtesy to others and also because I need it because of COVID, or are we really where we can go mask-free? We are confused.
Yeah, the CDC is saying that outside you can be mask-free. It's up to your personal level of comfort, but it's safe to be mask-free outside. And so where you want to see people wearing those masks is when you're close to other people, where you're indoors, particularly in places where the ventilation is not great, or if you are outdoors in places where you're really in close quarters with people. So if you're sitting really close to people, if you're in an area that's partially sheltered, if you're in one of those little tents that people have set up in places that don't have good airflow. So the outside mask-free is all about the airflow.
But Tom, something you just said was important, and that's why people are confused. Is it social etiquette or is it science?
Yeah.
Which one is it?
Well said.
Because the science, according to Lawrence Sauer, is that you don't have to wear one outdoor. And we keep sort of blurring the lines between ethics, science, and social etiquette, Lauren. I don't think that's helpful. What's your view?
Yeah, I totally understand that. I mean, I think it's a mix of all three, like you said. I think the science is evolving. And so that's what's really hard to message right now, right? So we're learning more about masking. We have not been a culture that masks. There's a lot of great scientists who are working on this right now. Where is sort of that line that everyone's looking for? But it is blurry, right? So it is an area where you want to see, if you're in close quarters, you wear masks because A, we do believe it keeps you safer, and B, it may keep someone else safer if you happen to be exposed or have the virus, and you're going to be close to them. Outside, I think it is safe. I think we've all sort of agreed that it is safe if you're spaced out to not wear masks. And that's what the science says so far.
We talked about this recently, and I'd love your view on it because a lot of people wrote in when we started asking the question. The goalposts seem to have moved from protecting the most vulnerable in society to now achieving some kind of herd immunity and getting 70% of the country with at least one dose of the vaccine. Lauren, why have the goalposts moved over the last 12 months?
I think the biggest piece is because we have vaccine available. And so we have targeted our most vulnerable people in the community to get vaccine first as we were scaling up, ramping up production. Production is higher now, and we continue to improve production so that we can not only target more broadly across our whole country, but also support global efforts to improve vaccination. But I think it's less that the goalposts have moved and more that the goal's gotten bigger. And so it's always nice when the goal is bigger because it means you've had successes to get to that point. But we're still targeting our most vulnerable communities, and especially those who have not been able to access vaccine yet. And there's a lot of work in that space being done, but the goal has definitely gotten bigger. More vaccine in more arms, more broadly across the country and across the world.
Lauren, very quickly then, let's circle around to the Padres again. Tonight, Coors Field, Denver, Padres, Rockies, 5,000 people, whatever in the stands. Would you wear a mask?
I think if it would depend on how crowded the concessions and the beer line is. But
the beer line. I would never be in the beer line.
I probably would wear a mask in the concession area, any place where I felt that it wasn't comfortable, in the restrooms. But again, if you're outside and you're feeling safe, that is a space where as long as you're socially distanced and you feel like you can keep that space between people, it's one thing. If you feel like you can't, I would put that mask on.
Lauren, have you ever had 3-2 beer, Coors 3-2 beer?
What is 3-2 beer? What is that?
This was from my childhood. This was the worst beer ever. It was before light beers, and it was like some holdover from Prohibition or whatever. And you guys are lucky.
It's like Bud Light.
It's like worse. It's like watered down Bud Light.
Like Natty Light.
Did they do that in Britain, John?
What, Bud Light?
No, and lighter than Bud Light.
Well, we call Bud Light something else, but I can't talk about that on air, can I?
Yeah, but like one of the great things of America is Coors 3-2 beer went away.
Okay. Well, Lauren's never had any, so thank you.
Yeah, that's good, Lauren.
Thank you for that. We appreciate it. Lauren, the idea that TK lines up at the concession stand for beer. Don't even listen to a word of that.
Absolutely.
Lauren Sarah, Johns Hopkins. TK, as if you sit in the seats that mean you have to go to the concession stand for a pint.
We need Kurt Gowdy now to help us with
break.
Narragansett lager beer.
Or Peroni. You tried Peroni, Tom?
No. Red Sox baseball, we don't have Peroni.
Moretti?
I've had Peroni. I like Peroni. I have Peroni.
Good.
It's San Carlos, this la-di-da restaurant in Soho.
Who recommended that?
I don't know. It's like actually real food. Good morning to San Carlo, where
Moretti's
they do serve
good too.
Peroni.
We should go and have a Peroni after work today.
We should. Maybe we should go Thursday instead of Friday, where the real yield occupies your time. John,
Honestly.
are you looking at the real yield? I mean, I'm sorry, as a data point
at the
today
real yield for the last
on
several
Inflation
weeks,
Wednesday,
sure.
I'm sorry, the real yield, how the real yield moves at 8:30 is a big deal.
Couldn't agree more. Let's get serious. The CPI print, 8:30 Eastern Time. The countdown continues alongside Tom Keene. I'm Jonathan Ferro. One of us might have had a Peroni already. It's not me. You do the maths. Futures down 0.4% on the S&P 500.
We say good morning to all of you watching at the Sink in Boulder, Colorado, where they still serve Coors 3-2 beer.
In the FX market, euro dollar 120, 124. What is that beer?
Well, it was like Prohibition. It was like lighter than Bud Light. It was
do they still do it?
No, they got rid of it. It was
Okay.
horrific.
Okay. Well, I'm pleased they got rid of it.
This is when Nixon was president.
Over the next couple of months, we will see significantly stronger inflation.
The consumer is still seeing spending in excess of what would be considered a normalized pace of spend.
This summer is going to be huge. People are going to spend, and the bounce back in oil demand is probably going to be significantly more than people have been expecting.
Certainly some commodity prices are just completely out of control. It's almost hyperbolic.
We are now at a point where supply is extremely low, inventories are extremely low, and demand's roaring. So prices are extraordinarily volatile.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
CPI 90 minutes away from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance live on TV and radio alongside Tom Keene. I'm Jonathan Ferro. Lisa Abramowicz is out of the building. Tom, equity futures down 0.4% on the S&P 500. It is CPI Wednesday. The data, 8:30 Eastern.
You know, I don't like the phrase CPI Wednesday, but let's be clear, folks. This is a big deal, particularly dovetailed in with retail sales on Friday, John. It's a give and take between price change and the good feeling of this economy. I would suggest, John, we see a good feeling for GDP.
Why don't you like the phrase? What's wrong with it?
I just, I don't like bannering economic data. You know, what are we going to have?
Why do we call it Payrolls Friday?
Because it's like a huge deal. I'll go with that as a one-off. What are we going to have?
Deal?
Inventory Thursday?
We can do that. We can do job claims Thursday morning if you really want to. I don't think that's appropriate. I'd rather stick with CPI Wednesday and Payrolls Friday. I think that's going to be the data point.
Empire State Index
through the next
Tuesday.
several months. Let's get serious just for a moment.
Let's do that.
The data in the last 24 hours, demand solid. We've seen that in job openings. Can supply meet it? And what happens to prices? Is price the solution for that gap between demand and supply?
In the pricing,
that's a big question.
The pricing power debate that we started yesterday, John, you got to believe that's a debate through the summer as well. How do corporations adjust to this? Robert Schiffman, moments ago at Bloomberg Intelligence, reaffirming Amazon and their credit quality after that $18 billion deal where you got the 40-year piece.
Basically, the Treasury curve, isn't it? At 10 basis points over the 2-year, Tom.
It's a government.
Basically,
it's
government.
Full faith and credit.
Couldn't agree more.
Yeah, I mean, that's all there is to it. You know, there's so many things to talk about, John, but I want to circle back to the gloom of Brexit. You lived it. You led our coverage there. And guess what? Citigroup calls the United Kingdom economy resilient.
PMI is north of 60. This recovery is just starting. This recovery in America is just starting too. The vaccine rollout there has been really terrific, as it has been in the US too. But Europe's catching up. And for that matter, Tom, I think Europe's coming together in a way that wasn't expected maybe several months back. And that's making more people bullish on the cyclical story.
We all use a Bloomberg terminal differently. I've got my own setup. John's got his. What I look at as a Euro proxy is Swiss 20-year, I should say, a positive 0.088. That's a litmus paper, John, of this kind of feeling in Europe.
The German 10's getting close to zero, getting closer to zero, back to levels we haven't seen since early 2020. decent move higher on the German 10-year yield in yesterday's session. Here's the move this morning. Here's your price action. We'll start with the bond market, shall we? 10 supply coming a little bit later in the Treasury market for the 10-year piece, the 10-year maturity. Right now, yields in a basis point at 161.12. In the equity market, down 0.4% on the S&P to 41.29. We're down 17 points on the S&P 500. An upgrade from BMO in the last 24 hours. Brian Bowski going to 4,500, Tom, from 4,200, and a tidy upgrade to energy in the mix as well.
We're seeing a lot of that, and it comes around, as you mentioned in the last hour, John, margin resilience observed as with 80-90% of earnings coming in. Yes, it's about revenues, but as David Constant said on Amazon a few days ago, look down at with the fangs at cash flow, look down at margins, look down at the quality of CapEx and investment, and that's where you get people going from 3,800 to 4,000. Maybe they're going from 4,200 to 4,600.
Let's bring in Matt Maley right now, Military-backed chief market strategist. Matt, the data, 8:30 Eastern time. Do you think we're still underestimating the price pressure that's building in this country?
I definitely do. I mean, one of the things, well, one thing though we do need to be a little careful of is that, you know, a lot of these commodities are getting incredibly overbought. I mean, lumber it came down pretty hard yesterday, but copper and some of these things, so they're probably going to come down at some point on a purely technical basis, kind of the way interest rates did in April, only on a technical basis. And so that might give some people some relief that, geez, inflation is really not a big deal. But I totally disagree with that. That will be a head fake if it does happen, because inflation has to do nothing but go higher. I mean, you look at what happened before the pandemic. We had record levels of debt around the world, not just here in the U.S., but around the world. Since then, the debt has just exploded even higher. When we have a situation like that, you only have two ways out. I mean, it's default, or you can inflate your way out. The Fed knows this. You don't want default. As bad as deflation can be, default's much worse. And so those who are thinking that inflation is going to be transitory, I don't think are right. I think inflation is going to be with us for a while. It may not be 1970 style, but it's going to be higher, and therefore rates are going to move higher. So
a simple one then, Matt. How are you positioned for it?
Well, I mean, first of all, you got to, you've got to play for the investments that are going to do well with higher interest rates. I mean, one of the things, I mean, I turned bullish on the bank stocks and financials in general, but mostly on the bank stocks back in October, because I saw the rise in interest rates, and it's continuing even more than I thought it would. Obviously as things have changed, I've changed my view, and I continue to say to feel good about that. I also see, again, if we do get a pullback in the commodities, I do think that would be a great opportunity to buy, but especially in the energy names. Again, this is another group. We hear certain people just turning positive, some big houses on the street, just turning positive on the group now. I mean, I turned positive back in October, and it just shows that there's still a lot of people have not moved into that area. Now, again, I don't think oil is going to come down because it's not overbought as much as some other commodities. Right. But it's going to be, I think, it's going to be important to do the right place.
Matt, does rising inflation cause equity market instability?
It's got to at some point, because interest rates are going to move up. I mean, it's the long-term interest rates. I mean, we saw what Bill Dudley talked about on Bloomberg op-ed piece. The market's not pricing in for these higher interest rates. And I mean, we saw in 2018, it was at that time it had to do with short-term interest rates. Said, oh, don't worry, interest rates are really, really low. The higher interest rates really won't make a big difference, until it did. And it finally did at one point. The same thing is going to happen with long-term interest rates. You probably, when you get above 2%, that might be two of a round number. Maybe it has to be a little bit higher than that. At some point, it's going to have an impact.
Man, I want, good morning, Vietnam. I want to go back to Vietnam, the 1960s and into the 1970s, where we had horrific inflation, gyrations, Walter Heller, and, all that. And the Dow was, John, I got to quote the Dow, I'm sorry, because it is the benchmark. But essentially, the Dow pivoted around 900 through that whole period. Is what we don't see coming is not the up, 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 or the down, 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 but we get range, range, range?
I think that could be very well be the case, because the Fed is still providing a certain amount of liquidity. And even though they're going to taper back, and as they keep telling us, hey, we have the tools if things get really bad. But I think they want higher inflation, and that they're going to be providing a safety net. It's just going to be a little bit lower than the marketplace. And therefore, as you say, with this sideways market, it's going to be much more important that investors are good at stock picking and group picking, not just buying the S&P S&P 500 ETF and going to bed.
So, Matt, when you and the team get together and you talk about the US dollar, what does that conversation sound like at the moment?
Well, the one thing about the dollar is it's still a very crowded trade. I mean, that being the short dollar trade, it's nowhere near as crowded as it was at the very beginning of the year, when everybody was saying that the dollar has to go lower, and of course it did nothing but rise in the first quarter. But it's still a crowded trade. Fundamentally, we have to know that obviously this whole issue with the climbing, the fiscal side of things, it means that the dollar should and almost certainly will head lower over the longer term. Right now, though, and it's at a key level here on a technical basis, around that 90 level. If we get below, it's a little below 90 is the March lows. You get below that, then it's Katie bar the door. It's going to be a big problem. But near term, I'm not as sure as a lot of people are that the dollar is going to break down from here. It could surprise a lot of people, and that could be another reason why I think these commodities will see a bit of a correction.
So is it fair to say that unlike the other inflationistas out there who like the trip abroad, international equities, you don't share that view, Matt, based on what you just said about the dollar?
Yes, that's true. I mean, one of the things that we got to be careful, though, is that, again, short-term trading versus long-term investments. Overall, we got to take these opportunities, though, when the commodities pull back, when the dollar bounces, take advantage of that to go back into some of the commodities, go back into some of the emerging markets. I think that's going to be a surprising play on a longer-term basis. So investors really have to stay nimble right now.
Interesting. Matt Maley there of Miller Tabak, the chief market strategist. Thank you, Matt. And appreciate the Dow reference too, Tom. It's important just to fit that in.
No, but John, this is serious. We make jokes about it. We're doing Chelsea Arsenal this afternoon.
Oh, yeah, that's serious too.
It could be a pause to reflect. Maybe that's where Abramowicz is, over at that match.
Will you acknowledge that given the increased importance of passive investing over the last several decades, Tom, that quoting the Dow is like offering the score on a game that no one's playing?
We do the Dow. No, I do not agree with that. We do the Dow benchmark for a zillion years. The SPX is a dramatically superior.
But who is it the benchmark for now?
The society,
in the
American
here and now,
society, not
society.
Consultants, not Boston Consulting, not Cambridge Associates, and the rest of them using it as a benchmark within buy-side and institutional. But just in a general statement in society, you wake up, you're in the Uber, you sort of are always, where's the Dow? Where's
so you're doing
Dow?
this for the people.
I'm doing it for the people.
You're doing it for the people.
I'm doing it for the people.
I'm pleased we cleared that
Can
up.
I point out, John, that one of the things that's really important here is we've forgotten what a range is.
Yeah.
In range bound. And there was the very ill-named Carter malaise, and where we just went flat for X number of years. And I mentioned 65 to 75 with a big drop-off there. And John, I'm sure you've got British benchmarks as well. What if we're slipping into a 3-5 year range?
Well, Tom, you raise a really important point, and I had this conversation with Lisa Mattingly of Fidelity and Savita Subramanian of Bank of America at a conference that Dean Kernod had put on yesterday. And it was a thoroughly enjoyable conversation. You were not invited.
Jesus.
I was. And when it came down to this, we asked the question, just explored it, just to think about it, a thought exercise.
Okay.
We've got used to this idea of zero rates and rates low for longer being great for markets. And I wonder where that idea comes from, because that wasn't necessarily the case at times in Japan. It wasn't necessarily the case at times in Europe too. And I wonder if we have to test that theory right here in the States as well.
I would go to Philip Carret, the giant of Pioneer, who said the white lights of inflation help a lot of people out. And that's where we're heading if it's moderate and doesn't jump up. That's the fear here. John, on mercredi inflation.
Nice. So much better in French. Futures down 15 on the S&P. We're negative 0.33% from New York City this morning. Good morning. Alongside Tom Keene, I'm Jonathan Ferro. On radio, on TV, this is Bloomberg.
With the First Word News, I'm Ritika Gupta. Colonial Pipeline says it will know by late today whether it's safe to restart gasoline and diesel flows. They've been on hold since hackers targeted that giant pipeline last week. Fuel shortages have spread quickly across the southern and the eastern U.S. Energy Secretary Jennifer Granholm says even if Colonial can restart today, it will take days to ramp up operations. Israel stepped up its attacks on the Hamas-ruled Gaza Strip overnight. Rocket squads in Gaza fired a barrage at central Israel early today, whilst Israeli warplanes pounded Gaza with dozens of airstrikes. According to Al Jazeera, the death toll in Gaza has risen to 48. More than 300 are said to be wounded. 5 people have been killed in Israel. Donald Trump's grip on the Republican Party will tighten today. House Republicans are expected to oust Representative Liz Cheney from her leadership post. Cheney has persistently rebutted the former president's false claims that the 2020 election was stolen. It's another tax defeat for European Union competition chief Margaret Vestager. Amazon has won a court fight over the EU's $303 million tax bill. The EU General Court ruled today that Amazon did not get special treatment from Luxembourg's tax authority. Last year, Apple successfully challenged a record $15.8 billion EU tax order. And the U.S. has agreed to remove China's Xiaomi from a Trump administration blacklist. That could have restricted American investment in the smartphone maker. Xiaomi had sued the U.S. government after the Pentagon issued an order designating the firm as a Chinese military company. Global news 24 hours a day on air and on Bloomberg Quick Take. I'm Ritika Gupta. This is Bloomberg.
This is a classical missing markets problem. Even the most mainstream economics recognizes that when a market is missing, there's a role for the federal government to come in and fix that externality. And here the negative externality is a barrier to work for people who want to get into the labor market. So this is just a very simple solution to a market failure.
I got you. Sounds good.
Jordan, how are you?
I'm good, John. How are you?
I'm okay, mate. Thanks for being with us.
Sure thing. Thanks for having me on.
That's all right. Going to be back in a couple of minutes' time.
Great.
This is your first time on this show?
I think I did one a while ago, but it's certainly been a while.
Okay. Well, the way it works, we'll come in with a bit of sound. I'll pick up. I'll hit the markets. I'll go to TK.
And then I'll ask you about Arsenal football.
And TK's going to come in and ask you a question that you might not know the answer to. I just want to get back in a stadium. Tom, we should do that. Next season, we should just go to Milan for the weekend.
It was a topic, John. I had a long discussion about it last night.
And we should do the show out of the Milan Bureau.
John,
yeah.
Don't get me going. I'm from the Winkler School of Vision on that.
Yeah, we should be in a stadium.
I told them, put me and Vivian on the balcony of the Peace Hotel in Shanghai on the 70th anniversary of the Communist Party. Everyone in the world would have wanted to be a guest on that show. We would have got Kishore Mahbubani. We would have got, name the China experts. Everybody would have wanted to participate in that. Just to be on it. That kind of vision. And we can do it in Milan.
I just want to watch the game.
Yeah, I know you want to watch the game, but you got to make a vision statement. You know, you get the UFI, you know these soccer people. You get the guy that owns Juventus. Who owns Juventus? Agnelli?
The Agnelli family,
yeah. You get one of them on. Whatever. I don't know. Get Ronaldo on.
This is a classical missing markets problem. Even the most mainstream economics recognizes that when a market is missing, there's a role for the federal government to come in and fix that externality. And here the negative externality is a barrier to work for people who want to get into the labor market. So this is just a very simple solution to a market failure.
That was Jared Bernstein, the member of the White House Council of Economic Advisors on Childcare in the United States of America from New York City this morning. Good morning. Alongside Tom Keene, I'm Jonathan Ferro. Lisa Abramowicz is out of the building. She'll be back with us on Monday. A well-earned rest through the whole week. In your equity market, 41.26 on the S&P 500, down around about 0.5%. 1 hour, 12 minutes from now at CPI in America. Going into that, yields come in almost a basis point at 161.47. Crude is firmer, up 1% on WTI to a 66 handle, $66 and around about 3 cents. And in the FX market, euro dollar declining 0.2% to 121 and about 26. 121.26 there, Tom. 1 hour, 12 minutes away from your CPI print.
Oh, lots going on today. And of course, we're looking at inflation as really the theme of the moment. But there's so many other themes, including how the political landscape of America folds into our economics, our finance, our investment. Jordan Fabian, our White House reporter, joins us this morning. Jordan, I want to go high above Cayuga's waters to Cornell and the sprawl of the history that you studied in Ithaca. Where's the Republican Party right now? From where you sit at the Democratic White House, where does the Republican Party sit as it looks back to 1860 and indeed 1856?
Well, I think what the Democratic White House would say is they've come a long way since then, and not in a good way. They're still consumed with infighting over the 2020 election and President Trump's baseless accusations of fraud. And today, where a key inflation report will be coming out that could have a lot of say on the direction of Joe Biden's agenda, they're going to be having a vote to oust Liz Cheney as one of their leaders in the House of Representatives over this dispute. So a lot of Republicans are concerned that they're too consumed with infighting and not consumed enough with combating Joe Biden's agenda.
Define for our international audience the smallness of the Republican Party right now. Are they so large that they're small as they're 49% of America? Are they lesser than that, or are they growing and shrinking ever more and more? Which is it?
Well, despite their weakness in Washington right now, they still have what I would think is a decent base of support. I mean, President Trump won 74 million votes in 2020. Joe Biden, despite having good ratings on his response to the coronavirus pandemic, still only has about a 55 to 60% approval rating. That's pretty low in historical terms for a president this early on in his first year. So, yes, I think that they are still a viable party going forward, despite all of the hand-wringing here in Washington.
How linked is the president to his Democratic Party? I think your observation on the polling of the president has been underreported, is really important right now. What is his linkage to Capitol Hill and, frankly, to the voters of the Democratic Party?
Well, I would say that Joe Biden's forte is links to Capitol Hill. He was in the Senate for 30 years. He has relationships with many of the folks there, and he's having a lot of them in this week to try to twist their arms, cajole them to get on board with his infrastructure plan, and he can rely on a deep well of relationships there. With regard to the base of his party, there was a split in the Democratic primary elections between the ascendant left wing of his party and him, which is coming from the more establishment wing. But so far, the progressives have been very happy with what he's done so far. So he's been able to keep them at bay, keep the peace, so to say, in the Democratic House. But we'll see how long that lasts.
We've heard a lot about this relationship that the president has with congressional leadership, Jordan, on both sides of the aisle. I just wonder if this is the real test now, whether he's got to demonstrate that it's effective, that relationship can actually generate some results.
That's certainly a test, John, is that does this longstanding relationship with Mitch McConnell, the Senate leader in particular, who has a lot of power given the 50-50 split in that chamber, can Joe Biden convince Mitch McConnell to go along with some kind of infrastructure package? I think there's a realization that this sweeping package that costs over $2 trillion that President Biden has proposed is going to get pared down or broken up into pieces in some way. But can he get Mitch McConnell to go along with at least one piece of that to get another achievement under his belt? That's going to be the test that is going to be underway in the next few months here.
We've seen a lot of blood being shed over in Israel, and we have to pivot from the domestic story over to the international one right now in the Middle East. Jordan, what is the president's position right now, and what has this administration said about what is happening between Israel right now and Hamas?
The bottom line for the Biden administration with this situation is de-escalation. That's what they've called for on both sides, both the Israelis and the Palestinians, to de-escalate the violence. In the broad scheme of things, I think the Biden administration would like to focus on China, the Asia Pacific, and not necessarily the Middle East. They're trying to withdraw back the U.S. presence there. You look at their withdrawal of troops from Afghanistan, but this conflict has forced this issue back onto their agenda, and it's going to be a headache for the Biden administration, no doubt, and also an impediment to some of their longer-term goals, like reviving the Iran nuclear deal if this violence continues.
Jordan Fabian there of Bloomberg, our White House reporter down in Washington, D.C. The kind of story that pops up now and again, Tom, but we haven't talked about in a major way, I think, since 2014. We touched on that a little bit earlier on this morning. It's certainly front-page news once more.
Well, it's front-page news and all that, but then it folds into the markets as well. I mean, the politics of the moment is a mess. And as I said, John, I saw a shift last weekend to where we're really starting to focus on lining up 2022. I mentioned Marco Rubio in Florida with a present battle, maybe, with the Democratic Party in what's supposed to be a Trump state. But I would fold it, John, right over to what, for me, on Inflation Wednesday, is the biggest mystery, which is the strength of GDP.
8:30 Eastern. Let me ask you this just quickly, Tom. At 8:30 Eastern, when that number drops, how do you think this administration spins it? We know how the Federal Reserve is looking to spin this number. What does the administration say?
They're going to spin it to continue to provide support to an America that's not participating in a 10% GDP economy. That's how they're going to spin it. And everyone, including the haves, agree there's a part of America that's not participating.
Pick a Republican state right now, and there's a good chance that that governor right now is ending the additional UI, the unemployment insurance. How does that play out? What are the consequences of that in the next couple of months?
It plays out to further polarity in America as other states choose not to do that, and it's uneven recovery. You know, I think, John, the nirvana is to get back to February before the pandemic, which was essentially an idea of low unemployment, the concept of fully employed America. Every report I read is we are nowhere near that, as Chairman Powell has stated, and quite frankly, others have stated.
But it plays into the political argument that Republicans have been pushing, that the relief package of the Democrats was simply too much and too broad, and that what we face now is higher prices because of that. Now, I know that's an economically flawed argument. Let's be clear about that. We can talk about that and pick holes in it for as long as we like. That's the political debate, and I just wonder how the electorate picks up on it.
Well, I'm going to give you one frame on Inflation Wednesday. What if inflation comes in lighter than expected? I'm not predicting that. But how does this market react to...
I imagine you get a nice move in the NASDAQ. That would be my guess. That would be my guess.
One reason to stay tuned, and also into the 9 o'clock hour. Look for the open today.
Thank you,
with
Tom.
John Ferro.
60 minutes away from the inflation data in the United States of America, on radio, on TV. This is Bloomberg Surveillance. "60 minutes away from a CPI report in the United States of America, live on TV and radio. Is the price action going into that? The S&P 500, 41.29 and down 17. We declined 0.4%. The Nasdaq down 0.6. The small caps underperforming. We dropped by more than 1 full percentage point. BMO's Brian Bowski upgrading things on the S&P to 4,500 from 42. Not alone in the last couple of weeks. We've seen that repeatedly. Jonathan Golub, top of the pile, looking for 4,600 on the S&P. Within that upgrade, though, an upgrade to energy and a downgrade to staples. Bear in mind, others are bullish staples. BTIG, Morgan Stanley, believing that that's where the pricing power is. Brian Bowski suggests that the higher commodity prices, long energy, the higher input costs for staples, that's going to weigh on things. That's where the debate is. Switch up the board. Yesterday was fascinating. When equities did badly, what did everyone say? It's about inflation fears. This is how we closed. Energy down 2.5%. Banks down 1.3%. If I showed you that yesterday morning,
but the
I
NASDAQ
don't think
came
we
back.
would have been talking about inflation fears. Precisely, Tom. Why was the NASDAQ ripping back? What happened to the inflation fears?
I think there's a huge bull component out there pushing against the gloom.
I'm with you. I think it's price looking for a narrative. And the narrative didn't fit the price at the end of the day.
Yeah, I go. Continue.
Bottom line, thank you.
Continue.
Let's finish on this then. In a bond market, 2s, 10s, 30s. We're getting on this morning. This is all right, isn't it? 2-year yield, unchanged at 15 basis points.
Unchanged from the jobs day, Friday.
10-year at 160, 165. You want your range, Tom? 174 at the high end to the close at the end of March. 146 at the low end.
I thought you meant the Dow range.
Friday's session. I don't do the Dow. I do the bond market. This is for serious people. Let's be clear about that. Your 30-year yield, 233.65. We come in a basis point. I think I'm done, Tom. Are you done?
No, I'm not done. Core CPI, 1.6% to 2.3%. That's the key thing. Which way does core tip from the survey of 2.3%?
And how does this market trade off the back of it?
Exactly.
Getting into the number. Thank you, Tom. Romain, you got some stocks for us. Good morning.
Put us out of our pain.
I do. Well, the fixation still remains, of course, on that CPI report. Tom, you did bring up sort of the, I guess you can call it the rally, if you will, in the NASDAQ yesterday. It closed down flat on the day, but it was the outperformer. But it was interesting to see what moved. You had Amazons, you had Adobes, you had a lot of those names moving a little bit higher and getting bid, but you had a lot of other stocks that really got left behind, including Microsoft, Apple, Tesla, and some of those names. The question is, what is really being priced into this market? And more importantly, what is really being bid into this market? If it is just a matter of profit taking and rotation, then maybe there's not really any concern. If there is a little bit more worry about some of those price pressures and whether they are starting to trickle in and start to erode away some of that growth and that growthiness that we've seen in these stocks, then that could be a concern. Microsoft down here in the pre-market by about 0.5%. Similar story for Apple and a similar story for Tesla. You flip up the board and you talk about risk sentiment. You take a look at some of the IPOs that we've had over the last 12 months here. Some of those IPOs are actually doing pretty well. We got earnings out of Upstart Holdings, big fintech company there, and Unity Software, which makes software for video games. Both of those companies not only reporting good earnings, but reporting very strong guidance as well. You're seeing that rewarded here in the pre-market with Upstart Holdings up about 20%, Unity Software up about 6%. Then the flip side of that is you have names like Lemonade, the big online insurance company. They're down 6%, 7% here in the pre-market, also on an earnings story here. When you put all this together, it really comes down to whether you buy into the growth narrative, the economic growth narrative, I should say, that macroeconomic growth narrative, and whether you are truly worried about inflation and about the Fed moving faster than anticipated.
And to me, the GDP adjustments we see, Romain, off Wednesday inflation and Friday retail sales will be fascinating, to say the least. Right now, this is a joy for John and I to bring in Terry Weissman with us out of Vassar and Harvard. Terry Weissman, iconic on emerging markets at Bear Stearns long ago. And most importantly, he is the director of global currencies and interest rates for the crew at 50 Martin Place in Sydney, Australia, with Macquarie, and we're thrilled he could join us right now with a real touch of this economics, but also it is linked to the commodity boom. Does inflation cause commodities, or is a commodity boom going to cause the inflation to come, Terry?
You know, it could be two ways. One of the aspects of inflation that I think is driving the commodity boom is just public policy, right? You have quite a lot of an imperative around the world to move towards a green economy, and that's clearly causing some commodity prices to go up. So here, the causality runs from public policy to commodities. But you also have to take into account that the rise in commodities, whether it's speculative or not, is going to put pressure on things that have nothing to do with that green economy. If copper prices go up, home prices can go up as a result, simply because of the cost push inflation. So it runs two ways. And I suspect that there is a little bit of a speculative element in some of the commodity prices that have seen a big increase recently, but more so iron than copper, let's say.
Right. Well, that's right where I wanted to go. Terry, when you talk to the commodity experts at Macquarie, and truly, folks, they are Australian experts, how does iron ore dynamics filter into a more developed world inflation Wednesday?
Not too much, because iron goes into steel, and steel is really a construction material. It's not something that's really prevalent that much in the consumer basket. But I will tell you this, Macquarie's view on iron is not positive. We see a lot of the run-up recently as having been caused by hoarding on the part of Chinese steel mills, who are worried the Chinese, in the second half of this year, Chinese policymakers will come down hard on the steel mills because of environmental issues, and that they will do that by restricting iron imports in the second half. And as a result, steel mills are hoarding iron now ahead of that, and obviously hedging against future price increases. But that's not really a demand-based story as much as it is a story about fear of import controls and fear of restrictions. Copper, as I mentioned, is a different story. That is purely structurally demand-driven. People are excited about the implications for copper demand coming from green economy imperatives.
Terry, what's China's role in all of this? If you showed me a chart of China's credit impulse, I might have made a different decision on the direction of travel that we're seeing across some of these markets. What is China's role in this cycle?
Well, normally China's role is as a commodity importer and demander. And of course, the credit cycle is hugely important to determining how much credit is being directed towards construction, towards infrastructure in China. So credit normally plays a strong role. But all I'm saying is that this time around, and maybe the reason you're seeing this divergence between credit growth and commodity prices is because in the case of some commodities, what's being driven is not structural. What's driving is not structural demand coming out of China, or certainly not the outlook for stronger structural demand. China, after all, may be moving towards monetary tightening in the latter part of this year. What might be moving these commodities instead is concern about restrictions on the use of them later, or the import of them later, I should say. And as a result, is hoarding today. Very different story, very different dynamic, let's say, than what we normally get out of China, where credit drives the commodity price cycle.
When you look at market-based inflation expectations at the moment, Terry, let's tie the two stories together. To what degree do you think they're being influenced by what we're seeing in the commodity market?
Not that much. To some extent, we're talking about consumer prices here, and the price of a house does not figure into the consumer price index, but figures into the consumer price index. Is the service price of renting a house, let's say, or the owner equivalent rent. That's not affected too much by the price of a home. So I don't think commodities themselves, certainly not those basic metal commodities, are having that much of an impact on CPI. No, I think what's having, or for that matter, expectations. I think what's driving inflation expectations is somewhat different. It's a Fed that has been politically inclined to sound very dovish and therefore fuel inflation expectations higher. And of course, we have everything pertaining to the demand impulse around the world coming from public policy, more spending in the U.S., prospectively more in Europe. I think that's fueling a little bit the inflation expectation increase that we've seen recently.
Terry, the vice chairman, I believe, speaks at 9 a.m. Wall Street time. Can they shock the market, or can they actually have a dialogue the next 90 days where we ease our way towards the beginning of a discussion of less accommodation?
So they can ease into it. And I think.
Can they do that?
Not today. Not today. Just because I said that they can ease into it doesn't mean they're going to ease into it today. I think this is too soon. Even if the CPI print comes out high, let's say on a headline basis of 3.7 or 3.8, it's way too early for the Fed to make a determination as to whether or not the increase in inflation is permanent or temporary. And the reason is because we know that a lot of it's driven by supply shocks, and the market has a way of addressing those supply shocks ultimately with more supply. And as a result, I don't think the Fed is going to say today, I don't think Richard Cloud is going to say today, that it's time for the Fed to talk about tapering. By August, maybe. I think by August they'll have eased their way into it, in part because by August the economy will be better. It'll be a more synchronized global recovery as well. Potentially there'll be some more pressure as a result of that on some basic goods, not necessarily copper and iron, but others. And I think at that point they can talk about the need to have a discussion about tapering. And then the countdown begins. But today's too early.
Terry, good to catch up as always. Terry Weissman there of Macquarie on currencies, commodities and rates as well. Vice Chair Clarida, 9 a.m. Eastern Time. It's 30 minutes after the CPI print in America. We will hear from the Fed Vice Chair giving a virtual speech to the National Association for Business Economics, Tom.
Maybe he'll get questions as well. They won't be as rude as the questions you gave him the last time we talked to him. I mean, it's going to be. I thought
he took those direct questions pretty well.
I thought he took them very well. Very well. It was good practice before this speech. John, I look at Inflazione Mercoledì. That was Italian. Inflation Wednesday.
Thank you.
And I'm sorry, but U.S. inflation redounds across Italy, across France as well. And there's going to be a global reaction to what we see here in 50 minutes.
And the conversation we'll have in markets will be different to the conversation that policymakers have. There is a difference between looking at the moment we're in and a policymaker who's focused on the destination, the direction of travel. At the moment is where this market's heading.
And this is great that we have all these different guests. I mean, I thought Weissman was brilliant there on iron ore. I mean, there it is, moving higher. Is it a market phenomenon? And he says, no, it's about the Chinese government and their state-owned enterprise.
The nuances in the commodity market, and also, Tom, the secular influence as well. This move away from fossil fuels too. That's playing a huge role in some of the price action we're seeing.
I nailed Macready in French. Mercoledì, how do you say Wednesday?
I think you nailed that too. Say it again.
Mercoledì.
I think you nailed that too.
Mercoledì.
That was great. I love doing European languages with you in the morning.
Well, I'm saying that Inflation Wednesday has a European impact.
Are you actually calling it Inflation Wednesday now? We're calling it
No,
CPI
I'm not.
Wednesday.
I was
well, you
ordered
did three
to.
times. Who ordered you to?
I don't know. One of our handlers.
8:30 Eastern. Jason Furman's going to join us too, the Harvard University professor and former chairman of the Council of Economic Advisors during the Obama administration, to get his response, Tom, to that inflation print when it drops.
It's an important conversation linking policy into the markets.
It is Wednesday, and we have some inflation data. You can call it whatever you like. Equity futures down 16 on the S&P 500. We're down 0.4%. Your yield is unchanged on a 10-year at 161.83. And in the commodity market, WTI has a 66 handle at $66 and around about 20 cents. We advance 1.39%. We are heard on Bloomberg Radio, seen on Bloomberg TV. This is Bloomberg Surveillance.
With the First Word News, I'm Ritika Gupta. The White House is facing rising pressure over gasoline shortages caused by the shutdown of that giant pipeline. The EPA has waived requirements across 12 states and Washington, D.C. to help bring more fuel to areas normally supplied by the Colonial Pipeline. North Carolina and Virginia declared states of emergency as gas stations ran dry. Meanwhile, the International Energy Agency said the supply glut created by the global pandemic has cleared. Surplus oil inventories in developed nations are now just a small fraction of what they were when demand collapsed last year. The IEA does see one temporary setback, though. Demand has been hurt due to the resurgence of COVID in India. More fallout from that fight over fishing between the UK and France. Bloomberg has learned that French officials want to prevent British financial firms from gaining access to the European single market. It's trying to pressure the British government into honouring its post-Brexit commitments on fishing rights. And Toyota has come roaring back. The world's largest automaker has unveiled a $2.3 billion share buyback and expects to return to pre-pandemic profits in the current fiscal year. Toyota has been able to pull ahead of the pack. It straightened out its supply chain and ramped up production to meet rising demand. Germany's Commerzbank posted a surprise profit in the first quarter, plus it upgraded its full-year revenue outlook. That's a boost for CEO Manfred Knof after he unveiled a turnaround plan to increase profits. Commerzbank's revenue soared 35% in the first quarter. The bank profited from strong trading and investment bank conditions. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
The Fed has said that they're going to be very slow to raise interest rates. They're not going to begin to raise interest rates until they get to full employment, 2% inflation, and they're confident that inflation is going to go above 2%. So we know that's going to take a while to convince them of that. Once they start, however, they're going to be late and they're going to have to catch up. And so this is going to be a period of slow, and then it's going to be a period of fast.
That was Bill Dunkley, the Bloomberg opinion columnist, the former Federal Reserve Bank of New York president. From New York City this morning, good morning. Alongside Tom Keene, I'm Jonathan Ferro. Lisa is out of the building, getting a well-earned break. She'll be back with us on Monday. From New York, here's your price action going into the CPI data at 8:30 Eastern Time. 7:48, equities 41.32 and down 1/3% and off 13 points. Let's call it 14 points lower. On the S&P 500, a bit softer in the bond market, just a touch firmer. Let's call it that. Yields lower, just a nudge, 61.83, Tom.
There's nudges and touches, John, but don't you agree with me? The market's really sending some signals here 45 minutes away.
I mean, we're pretty muted going into an important number.
Yeah.
The data in about 42 minutes.
Yeah,
Speaking of Bill Dudley, Tom, just quickly, out with the Bloomberg opinion column this morning with the following line, and it stands out in its own paragraph too. I think markets are severely underestimating how much that yield is likely to rise in the coming years. Yeah. This piece goes together what he was talking about yesterday, which is once we start raising interest rates in America, it will take a while. But when we do start to increase rates, it's going to happen more quickly. And the rate that we hit will be higher than this market expects too.
The 10-year U.S. Treasury note, part of the foundation of global finance, its yields helps determine the cost of mortgages. the value of U.S. stocks, and how much the U.S. government must pay to service its growing debt. I think markets are severely underestimating, as John, as you say, how much that yield is likely to rise. We thank President Dudley for his help with Bloomberg Opinion. Right now, our help with Kit Jukes. He is the Societe Generale and Chief Foreign Exchange Strategist. Kit, I want to go first to the inflation of the moment. What is the signal from the foreign exchange market that you see as we worry about the rate of change of rising prices?
I think we worry at anything that sends the world into a risk-off tailspin, because you get a high enough number to really make people shift from transient to oops, help. The Fed is going to be, walked off its perch. So anything that makes it look as if the Fed's going to have to change its story is capable of giving the dollar a bid this afternoon. But it would take a pretty big shock. But we are a follower in that sense. The stuff that hurts, that helps the dollar, hurts equities and sends the curve flatter in bond land.
All right, Kit, we've been looking at Europe today. A viewer from the Philippines emails in and says, what about inflación Miracules, which I think is inflation Wednesday, because I can't speak a word of Filipino. And the truth is that's a good example, Kit, of a 12% appreciation in the Filipino peso over the last 3, 4, 5 years. Does EM shift off what we see with rising inflation in the U.S.?
It does. They import some inflation. So, look, the EM countries, if you generalize, so the most developing, the least developed, the biggest share of their CPI is made up of raw materials, goods, commodities, the stuff where we've seen the price rises be the most important. So they take that hit that hit hardest. The saving grace for a lot of them is that their currencies have not been falling in the last 12 months so much, because they weren't starting from the dramatically kind of overvalued levels that we had 10 years ago. So they've had a bit more of a cushion to avoid anything really bad happening. But there's no doubt, these are the places where we don't talk about rent, we don't talk about services inflation. It's raw materials, commodity prices feed more directly into it, and oil is a big deal.
Okay, what was your reaction to the Bill Dudley piece?
I just listened to it. I watched it from a treadmill yesterday afternoon. And I thought to myself, this idea. So the idea of having a peak that goes higher than the last one by a margin, and that we've lost touch. It sits really badly with me, partly because the last time that we had a peak in rates that was above the one before it is in 2000, okay? And that, by the way, it broke a pattern, because since my career started, the 85 peak, the 84 peak was high, then the next one was lower, the one at the beginning, in the middle of the 90s was lower, and then we came down in the 2008 peak, and then we came down. And there's a reason for that. The debt level right the way through the system goes up and up and up. The average credit rating of companies goes down and down and down. When we all reorganize ourselves, mortgage rates go down, and people's salary multiple they need to pay to buy a house or an apartment goes up. And so we all get used to lower rates. So if you get a situation where we think that we're going to get higher rates than is currently priced in, the economy grinds to a halt and the equity market falls off the edge of a cliff. So it doesn't happen. And that's how it works. And the reason is, Bill Dudley says that the Fed is going to need to go above neutral. How far you can go above neutral has got to be a function of how far you went below neutral and how long you stayed there. We've had good reasons to go a long way below neutral this time. But now that we're here, I don't think we can go above neutral in that sense. I would be amazed. I would have a side bet with Bill about the peak in Fed funds. It's not going to be far above 2.5%.
Well, it sounds like you're doing that right now. The diminishing tolerance of a global economy, the US economy, to higher interest rates seems to be the argument that you're making, Kit. There's two pieces to Bill's argument, though. One is going through neutral. The other piece of it is the speed at which we get back to neutral, Kit. If we stay at these levels for a long period of time, and then when we get liftoff, do you have a little bit more comfort with the idea that the move towards neutral will be quicker than what we saw in the previous cycle?
Yes, I mean, because if you took the last two cycles, the Fed moved faster in 2000 and in 2004, 5, 6 than they moved in 2000 after the taper tantrum. Definitely moved quicker, and it's fair to say that cycle. I wouldn't hold up as an example of a great cycle because we ended the economic cycle with an exploding credit bubble. So we don't want to do that again. But yeah, I think there is a case for going faster to neutral, and hopefully, if you go faster to neutral, if you're managing the messaging right, you don't have to go further than that, and you don't blow up the equity market. But again, we're not starting from where you'd want to. We're here because we have to be. But
Kit, always good to hear from you, sir. Kit Jukes there of SocGen, the chief FX strategist. A bit of a debate there on expectations over the path of short-term interest rates, with Bill Dudley running a really interesting couple of pieces on Bloomberg Opinion in the last couple of days. Tom, you're familiar with the Jones Act, the boats that have to be owned, operated by American companies to transport whatever you want to transport from one port in America to another. That becomes a little bit more critical as we have a gasoline shortage. This from the Department of Homeland Security, standing ready to review any temporary Jones Act waiver requests from companies that demonstrate there is not sufficient capacity on Jones Act qualified vessels to carry fuel to the affected region. The affected region right now, of course, being the East Coast.
Yeah, this is a huge political football in America, a little bit of inside baseball there as well. We've got much more coming up, John. What are we, 35 minutes away?
35 minutes away from CPI. Up next, Alicia Levine of BNY Mellon from New York City this morning. Good morning. Alongside Tom Keene, I'm Jonathan Ferro. This is Bloomberg Surveillance on this CPI Wednesday. Yields 161.65 unchanged. Your equity market down 1/3%. The S&P 500 41.33.
Over the next couple of months, we will see significantly stronger inflation.
The consumer is still seeing spending in excess of what would be considered a normalized pace of spend.
This summer is going to be huge. People are going to spend, and the bounce back in oil demand is probably going to be significantly more than people have been expecting.
Certainly some commodity prices are just completely out of control. It's almost hyperbolic.
We are now at a point where supply is extremely low, inventories are extremely low, and demand's roaring. So prices are extraordinarily volatile.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Good morning, everyone. Jonathan Ferro, Lisa Abramowicz, and Tom Keene on radio, on television worldwide. We welcome you to Bloomberg Surveillance, an eventful hour. Jason Furman to join us later in the hour. We'll look at Goldman Sachs commodities. Alicia Levine on the American regime change here in moments. And John, it all centers around what every listener and every viewer knows. Prices are going up.
8:30 Eastern time. We're set to see that again. The CPI report just around the corner. Your number year on year to look for, 3.6%. That's the estimate in our survey from 2.6% previously. Strip out food, energy, the estimates as follows, 2.3%, up from 1.6%. And first of all, Tom, we look at the market reaction, and then second, how the Fed responds. Vice Chair Clarida with a timely speech lined up for 9 Eastern, 30 minutes after the report.
And you wonder how the language is going to change in that off what we're going to see in 29 minutes. John, I love the tension that we observe from Kit Jukes of SocGen with the former president of the New York Fed. And it's a legitimate debate about the rate of change of prices increasing.
Well, Bill Dudley believes that the Fed will do what it says it's going to do, which is keep rates unchanged for a long time. His argument, and I think it's fair to characterize it this way, is that when they lift off, it's going to be quicker than you think, and they're going to go through neutral and higher than you expect. So Fed funds could peak, in his view, maybe with a 4 handle. Kit pushes back against that because every single decade we've seen, every single cycle, with the exception of maybe one for the last several decades, we've added more debt, and our tolerance for higher interest rates has declined, and the peak in the Fed's fund rate has as well. Will that change this time around?
There's a great chart from Credit Suisse years ago from the wonderful Dominic Constam on that, of all the inflation worries that have been out there, the inflationistas that are out there, and they've been wrong. Well, maybe now is where we see a different time. John, help me with a data check here. I'm going to look at futures. A little bit soggy here, but I don't have the equity panic that we've had the last couple of days. Nevertheless, NASDAQ down 0.5%, down -86, S&P -12. The VIX does a little bit better. better all in all, 22.12. John, real yields, I'm focused.
Well, let's talk about the bond market panic that lasted about 5 minutes on Friday.
Yeah,
when we saw a low of 146 on 10s, right now 161, the high 174 from the back end of March on a closing basis. We've been pretty stable in and around this 160 number, with the exception of Friday's price action. I do wonder how we'll move around a print that comes in 27 minutes.
Yeah, and you wonder, John, let's frame this right now. If we get above a 2, whatever the number is, 2.3 on core or whatever, we get a higher inflation rate versus the shock of inflation subdued relatively. How do you think we'll see this?
The intuitive move, the one that would make sense, just as a guess, would be high yields at the long end, reflecting that upside surprise on inflation. From the equity composition standpoint, if it's an upside surprise, you'd expect the Nasdaq to underperform in that environment. And I would just say reverse engineer it. Whether that moves proportionally, symmetrically, I'm not so sure if there's some asymmetric risk around this as well. We had that going into the payrolls report. Right. There was a view that big downside surprise would generate a bigger move yields lower than big upside surprise yields higher. I wonder if the same is true a little bit later this morning.
We're all markets. John, I'm going to go to the real economy like Jason Furman, jobs formation. And that you wonder if a little bit of rising inflation finally helps people in a booming GDP economy, 8%, whatever the number is. So that's attention, folks, as we go here 25 minutes from now on the financial aspects and the asset aspects, the real economy aspects. No one better to dovetail those two together than Alicia Levine of BNY Mellon, always writing smart. And what's so important about Alicia Levine is really looking almost at a strategic basis of where we are given this rising inflation. You talk about a regime change, Alicia, in America. Describe that.
Right. So, look, we think that when the new administration came in, it was really focused on Main Street versus Wall Street. And I think the policies that have flowed from the fiscal side and, frankly, to the monetary side really are creating that. So as you've said all morning, you know, a little bit of inflation is actually quite positive for Main Street. You get higher wages, you get some pricing power, you know, you get assets moving higher. And in the real economy, that's not such a bad thing. It tends to be terrible for equity markets, particularly in the long duration assets, as we've seen in the last couple of days where the tantrum really was in the equity market and not in the bond market. The equity market is telling you that there are inflation fears all over the place for investors. So look, we think there is a regime change. So higher growth, higher inflation. That doesn't mean, you know, terrible inflation. It does mean, though, that higher than it was in the post-global financial crisis, and therefore higher rates eventually. But right now, we think it's sustainable. We don't think this is a sugar high. Okay, it's very clear. It's not a sugar high. It's Alicia, really a regime change.
You've got fancy degrees. You're expert at the mathematics of the financial system, and you and me have what in common as we started out dishwashing. You had a love affair with a Hobart dishwashing machine at a camp years and years ago. Let's talk about the real-world effects of this inflation. In the old days, that meant rising wages. Do you fold that into your strategy, or is this time different from when you were running a Hobart?
So those were great days, and actually I didn't get paid at all. So yes, there's inflation for those jobs, but look, there is clearly supply constraints in the labor market as well, which is what we learned on Friday. Wages are going higher, and they're going higher because we don't have as much slack in the labor force overall. Even if you strip out the extra unemployment benefits, which of course are a downward pressure on labor coming into the market. But if you think about the expedited retirements in the boomers, the 55 and above, you think about the fact that 2 million women have simply dropped out of the labor force, probably because schools are not open. By the time those schools open, you know, it's been 18 months that people are disassociated from the labor force, very hard to get back into the same job. So we think participation will be lower, slack is lower, and wages will be higher. You know, as we saw with JOLTS yesterday, there are 8.1 million jobs available, ostensibly the same number of jobs as those who do not have jobs today that did February 2020. Something's wrong, right? There's a mismatch. So there's a skills mismatch, and there's a need to pay labor higher. And I do think that the fiscal policy that's been enacted has conditioned people, frankly, to want more and to expect more. We've just spent $850 billion from January 1st in 2021 as the economy is reopening directly into households, directly into
bank accounts, more than we spent. That was $600 billion last year when the economy was closed, and we're expecting another $400 billion by early September. All that is going to create upward pressure on wages.
Next logical question then, what does that mean for margins, Alicia, and what are the sectors that you would avoid?
Right. Look, I think the rotation that became apparent in the fall last year still plays out, right? So, commodities, materials, industrials, financials, and energy are really the sectors that benefit from higher inflation, and that's where we would be. Very hard to ignore your profitable tech. The future is digital. You have to be there. We just think that sector probably underperforms a bit, and we do think that speculative tech, those companies that we know and love and are valued on revenue and not earnings, will really suffer here, and we would stay away from those. We just think it's a long-term secular change in where rates are going, where yields are going, and where expectations are going. So I think the cyclical trade will have legs, and will have legs for longer.
We saw a ton of companies in the first quarter raising prices, P&G, Kimberly-Clark, others as well. Alicia, there's a nice little debate playing out on the south side at the moment on staples. BTIG on the one side, BMO on the other. BTIG likes the pricing power. BMO's worried about the input costs. Where are you and the team on staples?
I like staples simply because they've underperformed so woefully that it's not a bad place to come in here. They do have pricing power. I think households are becoming conditioned to paying it, frankly, because there's so much extra liquidity in the household sector, right? You're not getting pushback. So therefore, those price changes will be sticky. If you add to that the sector has completely underperformed as the here and now looks better than worrying about the future 3 years from now, I think it's not a bad place to add to staples here. You want to add when it seems like the wrong thing to do. So
there you go.
Seems like the wrong. Yeah, there you go. I mean, we've learned this, right? How many times do we have to be hit over the head? And so I actually do like staples for that reason. I think this pricing power will be very sticky. When you raise wages, you don't lower them. When you raise prices, you don't lower them.
Get comfortable feeling uncomfortable. That's a life lesson,
Correct.
isn't it? Alicia, thank you.
Yeah.
Alicia Levine, BNY Mellon Investment Management. Your yield right now, I know you like the real yield, Tom, on a 10-year, negative 91 basis points.
And we're at the point where, frankly, that's a better number than an hour ago, and we'll see what happens here. I don't know what the equity markets are going to link in here in 20 minutes at time as well. John, I want to do some housekeeping here with the FT summing it up nicely, and that is BlackRock. John, I think this is really fascinating. They've been approved for a license with a Singapore sovereign wealth fund and a Chinese massive bank to do wealth management in China, I believe out of Hong Kong. Lawrence Fink commenting on that to the Financial Times. But, John, that's one of those little tea leaves of life goes on.
According to a statement delivered today, BlackRock's CCB Wealth Management Limited granted a license by the China Banking and Insurance Regulatory Commission to start its asset management business in the nation. There you go. The company 50.1% owned by BlackRock, 40% by CCB Wealth Management.
It's just one of those whispers, John, in the blur of all that we look at, where we'll look back in 6 months and say Asia continues.
Totally. Tom, we're getting back to business. And let's be clear about something else, too. The conversation we just had about markets is radically different to the conversation you will have on the very same theme with policymakers, because they've got to look at where this is going. They've got to look at the path, the moment, and not just the destination.
Well, and the inequalities here. This inflation, it's on all prices, but boy, does inflation hammer a huge part of America that's not getting the stock market right.
The report, 18 minutes away. In New York City this morning, good morning. Alongside Tom Keene, I'm Jonathan Ferro. Equity futures on the S&P, we're down 12. We declined a third of 1% on radio, on TV. This is Bloomberg.
With the First Word News, I'm Ritika Gupta. Colonial Pipeline says it will know by late today whether it's safe to restart gasoline and diesel flows. They've been on hold since hackers targeted that giant pipeline last week. Fuel shortages have spread quickly across the southern and the eastern U.S. Energy Secretary Jennifer Granholm says even if Colonial can restart today, it will take days to ramp up operations. Israel stepped up its attacks on the Hamas-ruled Gaza Strip overnight. Rocket squads in Gaza fired a barrage at central Israel early today, while Israeli warplanes pounded Gaza with dozens of airstrikes. According to Al Jazeera, the death toll in Gaza has risen to 48. More than 300 are said to be wounded. 5 people in Israel have been killed. Donald Trump's grip on the Republican Party will tighten today. House Republicans are expected to oust Representative Liz Cheney from her leadership post. She has persistently rebutted the former president's false claims that the 2020 election was stolen. And more fallout from that fight over fishing between the UK and France. Bloomberg has learned that French officials want to prevent British financial firms from gaining access to the European single market. It's trying to pressure the British government into honouring its post-Brexit commitments on fishing rights. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
Prices are extraordinarily volatile. Copper is heading in that direction, with inventories declining quickly and also moving into demand rationing. While as oil primarily is still very well supplied. OPEC is holding that capacity, so we are still trying to figure out what to do with all those spare barrels.
That was Francisco Blanch, who made some headlines over at Bank of America when we spoke to him earlier this week, looking for 13K on copper and maybe 20K at some point over the next couple of years. Yes, really. Take a listen to that conversation. From New York, alongside Tom Keene,
Yeah.
I'm Jonathan Ferro. Tom, I'll whip through the price action going into this CPI report 12 minutes away. Futures down 11 on the S&P. We decline a third of 1%, 41.35 on the S&P 500. NASDAQ futures just a little bit softer. We take some weight off the NASDAQ 100. Yields unchanged on 10s, 160, 165. Euro dollar 121.16. We come in about a quarter of 1%. And the commodity market, crude with a lift, Tom, timely, WTI 66.15. We advance a little more than 1%.
We're going to squeeze this in right now before the inflation report, and Jason Furman with us for a lengthy conversation afterwards on energy as we talk to Francisco Blanch or Sayed Morse at Citigroup or Jeffrey Curry at Goldman Sachs. His colleague in energy research, Damien Corvalin, joins us now with mathematics out of École Centrale Paris and, of course, operations research at Berkeley. Let's talk about the game theory of the moment, Damien. Berkeley leads in game theory as well. What is the push-pull of oil right now, given a recovering super boom for the developed world?
Hi, everyone. So I think the issue today in oil is still this excess inventory and excess spare capacity. But importantly, in a matter of months, this will dramatically change. We're on this cusp of a meaningful increase in oil demand as the world reopens, and supply just won't be able to keep up. So inventories will draw down sharply. They're already mostly normalized, so we'll have a tight physical market. And OPEC will need to bring barrels through the rest of this year and next year, erasing spare capacity. So, the market has rallied somewhat year to date, but we think there's another meaningful leg higher here.
And the somewhat is critical. And if you do a set of outcomes, you've got this scenario, this, you do 6-8 scenarios. Give us not a single estimate of what Brent crude will be at, but the set of choices you have of where Brent crude is a year from now.
So our forecast is $75. The risks around it, of course, first and foremost, is vaccine inefficiency potentially on significant new variants. That is an environment where the demand recovery is slower. You still get under investment on the supply side, but it's a more progressive rally. We'd still think prices above 70. The risks then could also be that the demand recovery is even larger than we expect, right? We expect jet to take quite some time to recover. EM demand to be more of a 2022 story. Once vaccination logistics are in place, they're scalable, right? So we've learned that in Europe, in the US, you could also see upside surprises in demand, at which point, this lack of spare capacity becomes quite problematic. Iran's a bit of a swing factor. If Iran's not back fully next year, then we're talking 85 and above Brent prices. But importantly, in most of those cases, because we're seeing binding underinvestment, because we're still seeing sequential demand recovery, next year's prices will be higher than today's spot price.
Do you see discipline in the oil patch, Damien?
I think that's a very important takeaway from the U.S. earnings releases just now. Producers, pretty much all of them, beat on revenues, yet none of them translate that in more spending. So, if anything, in fact, guidance a touch lower than we expected for production. So that discipline seems to be in place. Equity investors still reluctant to invest, but getting more comfortable. I think that's the right messaging for producers to stick to discipline and really create shareholder values. What does that mean? I mean, OPEC doesn't have to fear that potential significant shale ramp up. That means a tight physical market, normalize spare capacity, and as I said, sustain higher prices going forward.
At the epicenter of this call, then, is this demand shock. And you and Jeff Curry have been talking about this for a while now. And what I've always enjoyed about the research of yourself and Jeff is that you're always talking about the character of the commodity market, the energy market, compared to, say, equities, and why we can't price in this demand shock you expect right now. Damien, can you run us through that?
Yeah, that's essential. Let me give you one example. If you look at, say, airline stocks in the U.S., they're back to pre-COVID level. Jet demand in the U.S. is only halfway back to its pre-COVID levels. The commodity has to reflect that, right? If jet prices had recovered, we'd be swimming in jet without the needed demand. And so commodity markets are real assets, and they price today's mismatch between demand and supply. So demand rising next month is very important to next month rally in commodity prices, but you couldn't have priced that 2 months ago. Now, furthermore, and I think that's a critical one we're learning across commodities this year is once inventories are low, the commodities have to reflect that scarcity, right? It's lumber, it's steel, it's iron ore, it's corn, it's retail gasoline on the East Coast. That's what the next few months in commodities are likely to deliver.
Damien, shale and technology came to the rescue. And I'm going to use a phrase I heard from the economist Lawrence Kudlow a few years ago at Bear Stearns, which is focus on the lifting cost. Is there something out there in technology to help us with the lifting cost out 5 years from now? Or is the technology miracle over?
So, the easy gains are definitely behind us in terms of technology. Now, producers are always investing further. Digitalization may be that next source of improvements. But keep in mind, right, you've also had very low activity until now. So that's further depressed cost. As we saw in the 2000 cycle, ultimately you underinvest in services and you get input cost inflation. Second, and I think that's unique to shale and why shale was so different to other commodities, when you thought about costs, you also had to think about financing costs, right? Shale producers pretty much through 2017 benefited from very, very low cost of capital, whether it was on the high yield debt side, on the equity side, which meant that, they were actually operating below their pure technological cost structure. Now, OPEC was helping. OPEC was taking out the downside risk to oil prices. So you were further operating on a truncated perception of risk. That's over, right? And that's the key to shale going forward. Sure, it's short cycle, probably can get a bit better, but getting that external financing is much more expensive today. And after last year's experience, you cannot really bank on OPEC being there to always support prices. So your risks are higher and your cost of capital is higher. It changes the reaction function of shale, creating this tighter market going forward.
Damien, it's good to see you. Let's get you back soon. Damien Covel in there, the Goldman Sachs head of energy research on crude with Brent at 69.33, WTI at 66.09. Tom, what was that beer called again? What was it? Bud Light? What was it?
Coors 3.2?
Coors 3.2.
Yeah,
Coors 3.2.
Huge response.
What have they said?
Yeah, huge. It's like Bud
Is the
Light,
can smaller, but the price is the same, and therefore there is no inflation?
No. This was like prohibition. Like if you're 21, you could drink real beer, but if you were younger, you weren't responsible enough to drink real beer.
So it's
you had
Coors
to
half,
have,
not 1.2.
Well, it was like called 3.2 beer, which is a percentage of alcohol. And the problem was this was during Vietnam when we had 18-year-olds on aircraft carriers, really in harm's way. So it was ridiculous.
Coming up,
ridiculous.
Jason Furman, Harvard University professor
you learned something
of
today.
economic policy. That's why I asked. Thank you.
Furman may hang up the phone.
I imagine he'll want to talk about something else. The CPI report in America just around the corner.
Michael McKee's the only one in the building who knows what Coors 3.2 is.
Your 10-year, 162. Your equity market down a third of 1% at 41.33 on radio, on TV. CPI next. This is Bloomberg. are 10 seconds away from the CPI report in the United States of America, with futures slightly negative on the S&P. We are down by 1/3 of 1%. On a NASDAQ, off by 0.5 of 1%. Your bond market unchanged. It's 8:30 Eastern. Here's Mike McKee as we wait for the numbers.
Well, John, this is the inflation that you're looking for, and it comes in hotter than anticipated.
Wow, hotter.
CPI on a month-over-month basis up 0.8%. The forecast was for a 0.2 gain. That pushes the year-over-year CPI to 4.2%. That's much faster, of course, than the 2.6% that we saw in March and the 3.6% that was anticipated. Let's take a look at the core rate, up 0.9%. There's the one that's going to worry Wall Street. The forecast was for 0.3. It's 3 times the amount in March. And on a year-over-year basis, we're up to 3% on the core. The estimate, 2.3% for the month. So a lot of inflation. I'll look at, I'm sure you want to look at the market reaction. I will look at the breakdown of the CPI here.
John,
what do you see? Mike. I'll look at the price action right now. The NASDAQ down hard, off by 1.65% on the NASDAQ 100. The S&P coming in 1.1%. This is the story we were talking about. If you've got an upside surprise, it's going to hit the NASDAQ harder. Yields higher. In the belly of the curve, on a 5-year, up 2 basis points. On a 10-year, up about 2 basis points as well. At the very long end, by about 0.5 basis point on the 30-year, and basically unchanged on 2s. So it's an upside surprise, Tom. And after an upside surprise, what do you get? You get high yield through the belly of the curve. We'll have this conversation what it means for short rates in just a moment.
Yeah.
But the NASDAQ lower, the S&P 500 lower too.
I want to stay in the markets here before we get to Dr. Furman. But, John, what I would really point out here is this is different than Jobs Friday. We saw a market adjustment, Jobs Friday, and then a quick recalculation based on that historic report. This is a reset, John, that we're seeing right now.
Well, before we get into levels, relative to what we expected, it's positive, negative surprise that matters to markets in the near term, Tom. We've had an upside surprise on inflation and a downside surprise on some of the data on payrolls. That's not exactly the greatest mix for risk assets.
Still following us in the markets, the Dow down near 200 points, SPX down 38, VIX out 2 points. Michael McKee, what's your observation?
Well, it's kind of interesting, Tom and John, because we're looking at energy prices. They're down on the month. Overall energy down 0.1%. Motor fuel down 1.3%. Gasoline down 1.4%. So it's not the kind of gasoline story that a lot of people thought it might be. Where we're seeing some increases is in apparel, up 0.3%. New vehicles are up 0.5%. And, of course, used cars, we've been talking about this for a long time.
Steve Matthews on that.
10% on the month.
So your report there right now is used cars up 10%.
Used cars are up 10%. And, Tom, you can go sell that old flivver that you've been driving around in.
Yeah, the Nash Rambler. I'm not selling it.
We also get a little bit of inflation in shelter as rent prices go up. 0.4 increase in shelter, but owner's equivalent rent, the way they calculate home prices, only up 0.2%, and that has been the story. Apparel up 0.3%. The last 3 months they were down.
With this higher inflation, the real wage goes down, and we see that on the Bloomberg terminal here. Can you ascertain with the market data, the economic data rather, what wages are doing?
Well, it's kind of hard now because we got all of the base effects mixed up in all of this and last year's impact. I will have to take it apart a little bit more to figure out exactly what's happening. But as you mentioned, real average earnings on a year-over-year basis, weekly earnings down 1.4%, and average hourly earnings down 3.7% when you account for inflation at this point.
And, John, markets deteriorate further.
It's another big miss for the economics community, isn't it? A big, big miss. The median estimate going into this was 3.6%. The headline number coming in year over year, 4.2%. We have a move lower, just a bounce off session lows on the NASDAQ 100, still down 1.4% on the NASDAQ 100. On the S&P 500, off by 0.9%. I'll just go through the bond market for you quickly, Tom, because we had an initial break higher rather, in Treasury yields. It hasn't stuck that hard. Your 10-year yield up about 1 basis point, your 5-year up 2 or 3. They're not major moves in the bond market. Let's be clear about that, Tom. Just on a nominal yield. Focusing on the nominal yield here. The 10 years up about 1 basis point, call it 2. The 5 years up about 3.
Yeah, it is. I mean, in the yield space, and again, I'm going to go back to real yields, John, where you've got a higher, less negative real yield here, and we're going to recalibrate through this, but I'm not sure what we recalibrate to, other than the observation, John. which our listeners and viewers know.
Well,
there's inflation.
This market's having a very different conversation to the conversation that academics and policymakers are having at the moment. In 25 minutes' time, do you think the script has changed for Vice Chair Clarida?
Oh, come on, he's got to address this.
Do you think it's evolved? He'll address it, but do you think anything's changed substantially for the Vice Chairman of the Federal Reserve after that inflation print?
We'll talk to Dr. Furman quickly, John. One more observation, please.
NASDAQ gets hit hardest. That was anticipated. I have to say, in the bond market, if you told me we'd have an upside surprise this big, I'd have expected a bigger move than the one we've got on the screen so far. 164 on 10s. 164
on 10s. The 2-year yield gives me a figure 1.15 rather to 0.16. Right now, an extensive conversation with Jason Furman of Harvard University and, of course, his public service to the nation with the Council of Economic Advisors. Jason, wonderful to have you with us at this moment. You're going to tell me as a public policy type that we need to see more data, that we need to see 2 or 3 months data. Does President Biden and others wait for that data, or must they adjust to this report?
Look, I think the main people who need to adjust to this report, adjust to the jobs report we got last year, is the Federal Reserve. The other part of it is looking at what we can do in our economy to address the biggest thing we have, which is a constraint on supply. We need more supply. Shots in arms are doing a lot. My guess is there's a lot more people working in May than in April. But when you take this, plus the jobs report on Friday, plus the totality of the data, I think we have a very different picture of the economy right now than a lot of people held a week ago.
It's a different picture of the economy. Vice Chairman Clarida will speak here in, I believe, 24 minutes. Does he adjust? Is there one word or one sentence that will begin a tone of a Federal Reserve shifting their language?
I don't know. I mean, they're very big on this being transitory. A lot of this is transitory. We saw a 10% increase in the used cars and trucks market in April.
Okay, but Jason, I don't want to interrupt you, but I'm looking at rentals in New York City that are not transitory. As Michael McKee just mentioned, higher rents are real, not transitory.
Oh, I agree. Oh, I was going to say, you are going to be able to point to things that are transitory. I think your best guess has to be that this isn't entirely transitory. The Fed and others have rested a lot on inflation expectations being anchored. This is the type of thing that's going to start to move those inflation expectations. So yes, I think the problem is you can point to all sorts of transitory things, strip all of those out, add in what we know about how much demand we have in our economy, how little supply we still have. I think this bears some caution and should change the way people are thinking about the economy.
Jason, what do you think that means for the relief package we passed just a couple of months ago, when Larry Summers and others, including Olivier Blanchard, came out and said it was too big for the moment we're in? Do you think this is evidence of that?
Oh, it was definitely too big for the moment. I don't know any economist that was recommending something the size that what was done. The question is how big the downside was. I wouldn't leap to a judgment yet on the basis of April. This is 1 month's data. The data are obviously extremely noisy. We knew as the economy reopened, there would be all sorts of patches along the way, rough patches along the way. But, I think there's a certain amount to that logic. And let's try to do what we can to make it not true. How do we make Larry's prediction not true? We increase labor supply, and the Fed is a little bit more cautious to help keep inflation anchored.
Jason, can I get your thoughts then on what happened on Friday when we saw that big miss and we talked about the supply side story and the mismatch between demand and supply, and that maybe prices would need to adjust? Arguably, as you've pointed out, we saw that in wages already, and we could see that a whole lot more in months to come. Some governors of Republican states have decided that they need to remove the additional UI, the unemployment insurance that was offered by the federal government and the package that was delivered recently. Do you think that's the right decision to fill that gap?
Yeah, so the big miss on Friday was wages. The expectation for wages was 0.0%. The actual number was 0.7%. Even that actual number understated what actually happened because of composition effects. The real number is probably more like 0.9%. Either way, that's the fastest wage growth we've had since the 1980s. So you're not looking at one isolated data point around used trucks. This is everywhere around us. If I were in a state with a 3.5% unemployment rate, I'd be thinking seriously about whether paying people more to not work than to work was a good thing to continue doing.
Jason, lost for words there. Are you in agreement with Republican governors then in places like Arkansas, Iowa, Montana, South Carolina?
It depends on where you are in the virus. It depends on where you are in your unemployment rate. But certainly by June, July, August of this year, I don't think we need the same UI system we had in January. In January, it made sense. 3,000 people were dying a day. We wanted to give people an option other than work and support them in that option. In an increasingly hot labor market for a lot of states, it may not make sense. It may not make sense in the same way. So I think they should be taking a hard look at it.
Dr. Furman, I just did a study here. Thank you, John, for extending that out because I was working the Bloomberg terminal. Jason, I did a standard deviation study on a monthly basis of core CPI back to the time of Paul Volcker. Maybe around 1990, I can find a jump condition in core CPI like we see now. We do interview after interview where experts like you say it's about the jump that we see in inflation. Right now, we're seeing a jump that I would suggest is near original. How should we respond to that?
Yeah, the economy is going to do weird things. We saw a collapse that was, historic last year in prices. We're seeing some of what we're seeing now is the unwinding of that. Some of what we're seeing is different sectors come back at different paces. So I wouldn't leap all the way to where, we're not worried about inflation. Now we're worried about hyperinflation. It's going to be 0.9 every month from now on. But, what I'm saying is just a recalibration of views. Discount the data a lot because of the weirdness. Don't discount the data all the way. You should update your views some.
Let's recap the data right now. Jason, stay close. I just want to go through the price action. The S&P 500 did decline off the back of that upside surprise. We bounced off the lows. We're down 0.7%. Similar move on the NASDAQ. The NASDAQ rocketing lower and then bouncing back just a little bit, still negative 1.3%. Into the bond market, you'd expect a sell-off. You got one, a mild one. Yields higher through the belly of the curve. The 5-year up about 3 basis points.
John, you are dead on.
The further you go out, Tom, on 10s,
you are dead on the 10-year yield.
30s coming in about a basis
John,
point.
John, the 10-year yield has not moved at all, essentially at all. It's well contained.
164. Yeah. The lows of Friday, 146, then a huge bounce higher off the back of that. And if you think about the higher, the recent range, 174 at the close of March, at the end of March on a closing basis. So we're some way off that, 2 basis points higher on the day. Mike McKee, the data comes in. For the economics community, it is another monster miss on Wall Street, together with that payrolls report.
Well, yes, but I'm going to give all of my compatriots on Wall Street a pass here.
I'd expect that, Mike, of course.
It's very hard to do when you have this kind of base effect changes. I mean, we're looking at things like men's apparel was up 1.3% during the month, and a year ago it was up just 1%. So there's no real change there. How do you know what's going to happen? But apparel overall is up 3%. It was up 1.9% last year. So you think things are going to go one way, and they end up going another, and it's kind of hard to tell.
With the data this volatile, though, TK, I think it raises some questions about markets and how you trade the incoming data. How sensitive will markets be to incoming data if the data set's this volatile and this hard to forecast?
Well, we heard that from Dr. Furman. I mean, the cliche is to go to a 3-month moving average. But, John, I am really taken, given it's a natural disaster, the pandemic, I get the originality of it. You look at core CPI, and the jump up is well outside 2 standard deviations on a monthly basis. That's a ginormous move. I learned ginormous from Furman.
Well, let's reset. Tom, just quickly, before I have to run, how do you think that meeting in the White House changes later? between the Big Four and the President of the United States with this inflation data this morning. Now, every single market participant, every economist will come on the show today and talk about it only being one data point. But that's the data point, I imagine, that the Republicans will be talking about all day going into that meeting in the White House later.
Yeah, the meeting is there, and that's a political discussion. It'll be emotional like gasoline and all that. I'm way more interested in people like Jason Furman, and I would go to the vice chairman, where particularly if he does Q&A, John, that will be fascinating.
We get the Q&A in about 15 minutes
time.
I didn't know that.
Okay.
Jason, just a final one from me before I have to run. Your view on that, how the Federal Reserve will talk about this when we hear from the Vice Chair in about 15 minutes. What would you anticipate? What would you expect them to say in the coming weeks off the back of this data?
I would expect them to make very little in the way of adjustment. I would expect them to emphasize this is transitory. Some of the quirkish parts of this, like used cars and the like, I'd love to see them tilt a notch towards concern about inflation, but I think they'll mostly be doing more to explain this away than to express any concerns about it.
TK, I've got to run. I'm going to catch up with Chris Romani a little bit later.
Oh, that's good.
And then I'm going to catch up with Subhadra Rajappa as well from SocGen. I'm going to do that in about 15 minutes' time.
That dialogue will continue through the morning here. And again, if you're joining us, a real shock, I'm going to use the word shock as we see too inflation. Because of the shock of this report, we had 8, 9, 10 themes to speak to Jason Furman about with Harvard University. Always interesting, but we've really got to stay here, I think, on price change. Jason Furman, let's do a little bit of a history lesson of the shock here. And I went back to 1990. Neil Dutta talks about the biggest one-month gain since June of 2009. Dr. Furman, take us back to the 60s. And Robert Samuelson at the Washington Post has written about this, the time of Walter Heller. What did they do in the 60s about the inflation shock? And should we use that as a template?
First of all, they did a lot of emphasizing one-time factors and micro stories. You know, there's this segment is doing this, that segment is doing that. And they missed the bigger macro forces, what was going on with fiscal and monetary policy. So, you know, number one is look at the macro. Don't try to explain away each one of the micro. Lesson two, though, which I think is a good one for us, it took years and years and years of a policy change to get us to the place we were at in the late 60s. We've just been through a freakish pandemic. We've just been through a highly unusual period of policy. I don't expect policy I don't think there's been a huge regime change. I think we'll go back to the old regime, and this should hopefully all stay under control as a result. But we do need to get back to a little bit more of the old regime for that to work.
We certainly heard that from Jan Hatzius yesterday, folks, of Goldman Sachs. Then I look at what wages will do, and there's that phrase from ancient history, Jason Furman, cost push inflation. I don't observe that anywhere. Am I wrong? Are we going to redux the 60s and 70s, I should say, and cost push inflation, where we have to whip inflation now?
I mean, we just saw that in April, wages were up by about 0.7, 0.9, depending on how you look at the number. Prices were up by that same amount. Again, I mean, we obviously don't want to read too much into any one data point, but unless people start heading back to work in bigger numbers, we're going to have concerns. Now, that should happen. It should happen no later than September, when unemployment insurance expires. But, it needs to happen.
Jason Furman, thank you so much. Greatly appreciate it, with Harvard University and, of course, the Peterson Institute as well. On the bond market, I thought John Ferro was absolutely dead on, about 1.64%, rounded up maybe 1.65%, a 3 basis point move. Seems contained. Ira Jersey is our expert at Bloomberg Intelligence on fixed income, on the dynamics of full faith and credit at the very short market, and again out at the 10-year space. Jason, what does it signal that the 10-year seems somewhat contained? Excuse me, Ira, what does it signal?
Hey, Tom. Yeah, I think it's contained in part because everyone knows that this number was going to be crazy volatile. It was, how big was the bounce back going to be given the base effects? I think people are looking through that. But, when you look at the dynamics of what is causing that 3-ish basis point sell-off in the 10-year, it's coming mostly from break-even. So it's mainly from people thinking that maybe inflation will be higher. We're now approaching 2.6% inflation expectations over the next 10 years. And, that would be not unprecedented, but you'd have to go back to the early 1990s to get that kind of year-on-year inflation for several years. So I think, the market is pricing for this, or pricing a little bit more, but we're probably nearing fully priced.
Yeah.
I think at some point in the near future.
I was channeling you, Ira. I was doing a chart on the Bloomberg as you were speaking of the yield of the 10-year back to Volcker, back to 1990, and I ran the regression, and granted, we've broken out a little bit. Can you say we have broken the great disinflation, the great moderation?
Well, I don't know if we've broken the great moderation, but I do think that long-term downtrend is probably over. I do think we've reached the lower bound, and I think at this point where we're going to be searching within this cycle for what might be, the longer-term 10, 20-year top in yields, which is probably below 4%. I don't think we're going to see any kind of inflation or growth or dynamics that are going to cause Treasury yields to go above 4% unless we do something silly like talk about not paying our bills, not with some kind of default probability. Otherwise, we're likely contained in terms of yields. And Tom, I want to bring up a little fact here. Bacon prices were up 10% last month, year on year, but egg prices were down 9%. So don't worry about the price of your breakfast for now.
Very good. Ira Jersey, too short a visit. Thank you so much. And he will write this morning on what we see from Vice Chairman Clarida and, of course, off this report as well. Michael McKee is doing what Michael McKee does best, really diving into what is a wide set of data. What's the thing that sticks out? You mentioned cars, used cars, but what's the thing?
Well, a lot of it seems to be the reopening prices. We're looking at things like used cars were up 10%, as you mentioned. Car rental up 10.1%. Airfares up 10.2%.
Felt that.
Lodging, hotels and motels, 7.6%. So you can understand where some of these price pressures are coming from. These are people who had no business for the past year or so, and their prices are firming up a little bit. Televisions were up 3.1% as the surveillance simulcast starts to come together.
It is. It's a national
everybody.
effort.
But just to follow on Ira Jersey, don't worry about breakfast. He's right about the numbers there, but do worry about your next trip to Fenway, because hot dog prices are up 2.7%. That's a large gain. And sporting event tickets up 10.1%.
All that is wisdom, and it's affecting all of our viewers and listeners. But to me, the really salient point is do elites like Richard Clarida, do they digest that data and do they understand that effect on the public? Or am I going to get a Columbia University dissertation from the professor today?
They understand. But remember, he I'm sure wrote his speech before the numbers came out.
Oh, they have to adjust one sentence.
He is sitting down with Ellen Zentner, and she will be asking questions.
She'll grill him.
We know Ellen.
She's brutal.
She will grill him. But I think Jason was right. There's no advantage to the Fed in panicking or saying anything beyond this is transitory at this point, because they got to take apart the numbers. There are a lot of base effects. We have to see what happens from here on. Do we see these prices continue to rise?
This is critical. I don't worry on time, Riley. Help me out here. This is critical, Mike. If prices go up a big amount and then they go level, is that something the Fed adjusts to? I mean, we all get rising and lowering, but what if we get pandemic up and then a new leveling of the price level for a year or two?
Well, that's fine with the Fed, because then inflation isn't accelerating, and that's what they're worried about. They want inflation to rise at a 2%, little bit above 2% rate for the next year or so, and then to settle in at 2%. So if they get something like that, that's exactly the kind of soft landing.
Can they control the settling in?
They can't control it. As Alan Greenspan once said, using monetary policy to do this is like operating on someone with an axe. It's very difficult, but they're going to aim to do their best with it. And this doesn't change the narrative for the Fed because they're looking at this going, yep, that's exactly it. Now, let's take it apart. Let's look at the individual components. Let's figure out, are airfares going to rise 10% every month? Probably not.
That's my point. They'll go level.
Yeah.
We're out of time. And we will continue. Michael McKee, I know, will drive forward the conversation with various parties, including John Ferro, here through the morning to bring you up to date. And I really think this is important. Jobs Day with all the focus, and yes, it was an historic Jobs Day. This is an extraordinary statement on price change. This goes back to my youth, if you will, with Arthur Burns and moves that weren't measured, where there was a real ability to control inflation. I'm not suggesting we're there, but certainly we see a jump, as I mentioned, on core inflation, where I can't find an analog back to 1990. And I love what Neil Dowda at Renaissance Capital points out of a lift here that we haven't seen since 2009 or 2008. You heard Professor Furman push that aside, as Jan Hatzius did yesterday of Goldman Sachs, and say transitory seems to be the word of the moment. What is not transitory is our need to do a data check, and we will do that. S&P futures, negative 29. Dow futures were negative, I think, 200 at one point, now negative 117. The market moderates. The VIX 23.06. Out a good stick, 1.22 points. The bond market, there we have a now full 165 print. So critically, as John mentioned, with the leap, we had a higher yield, and now we have an ever higher yield as well. I'm waiting for $70 on Brent crude. We're not there yet. There's so much to talk about. Please stay with us through the morning on Bloomberg Radio and Bloomberg Television. Good morning.